Okay, good afternoon and welcome back to docket number 210515 REO1. This is the reopener into revenue adjustment mechanisms for a performance-based regulation framework. We're here this afternoon for our 13th technical meeting in this matter. We have an agenda in front of us today that will take us likely all the way up to the close of business. So I'm not going to waste any time. I'll turn it right over to Mr. Kramer to get us started here, please.
Thank you, Chairman Gillette, and thank you, Commissioners. Good afternoon, everyone. As the Chairman mentioned, my name is Peter Kramer with Authority staff, and I'll start the meeting by laying out our plan for the afternoon. First, our meeting objectives. We are here to further develop key potential regulatory reform topics related to performance-based regulation. And particularly today, we'll delve deeper into the subject of return on equity and its relationship to performance incentive mechanisms, or PIMs, in a PBR framework. And our second objective, as has been the case with these in-person roundtable meetings, is to enable additional open dialogue and development of ideas among the folks joining us in person today. So with that in mind, we will address a few housekeeping items. First, this technical meeting is being broadcast live on PURA's YouTube channel, and the recording of the live stream can be found there after the meeting as well. We're also joined by a court reporter today, and the transcript for the meeting will be posted when it's available. So for our participants seated at the tables today, please ensure your microphone is on and speak into the mic so that both in-person and remote attendees can hear you. With respect to folks seated at the tables, these are our roundtable representatives from docket participants and stakeholders. And as indicated in the notice of technical meeting, these identified representatives are the main participants in our roundtable discussion today. Other representatives in attendance may confer with the identified representatives and may be recognized to speak as relevant to the discussion and as time allows. So with respect to those discussions, if necessary for our roundtable representatives to confer, please just step away from the desks, have the conversation you need to, and return back to the tables. We will move the agenda forward while you are conferring. And if speakers seated in, or I'm sorry, attendees seated in the audience would like to be recognized to comment or participate, please just step up to the podium, state your name and affiliation, and we will, once recognized, and we will recognize you at that time to make your remarks. Next, we do plan to have a break today. Right now, it's tentatively scheduled for about 2:45 this afternoon. We'll keep that a little bit flexible depending on the nature and timing of our discussion. And for our format for that discussion, we have two general topic areas to cover today, as you may have seen on the agenda, though admittedly there I think will be a lot of overlap and a lot of sort of free-flowing nature of the topics in discussion here. The first that we identified is a discussion related to risk and how it may be reflected in the calculation of ROE and relatedly revenue requirements. And the second topic identified is a number of other topics, including cost of capital and materiality. So with that, we recognize that the straw proposal did not address the relationship between ROE and PIMs specifically. So we have no staff summary to provide at the outset of these topics, but instead we will start with just brief 2-minute opening remarks or comments that each seated party may like to begin and open the discussion with before we get to questions from authority staff. So before we do that, let's start with our introductions for our roundtable representatives today. If you could each please state your name and affiliation, and we can start. Mr. Horton, with you, please.
Good afternoon. I'm Doug Horton. I'm the Vice President of Distribution Rates with Eversource. Here with me is Alan Felsenthal with PricewaterhouseCoopers. We had originally had Sean Riley submit an expert report on November 6th dealing with performance incentive mechanisms, return on equity, and the regulatory compact. So Alan will be giving a brief opening statement, although I think you said 2 minutes. We had instructed 3 minutes, so hopefully you can maybe afford some latitude in the timing.
Thank you.
Can we do the statement later? We'll do intros and then statement.
Yes, please. If you could just state your name and affiliation, and we'll come back for opening remarks.
Okay, good afternoon. My name is Alan Felsenthal. I'm a managing director at PricewaterhouseCoopers.
Good morning, Charles Rothenberger, Director of Government Affairs for Save the Sound, and I'm joined by Paul Robigo, Robigo Energy. Introduce himself. That's it.
Very good. Thank you.
I'm Andrea Van Leuling. I'm the networks controller here on behalf of UI.
Jacob Hurwitz, Senior Director of Revenue Requirements here on behalf of UI.
Jay Goodman of the law firm of Couch White LLP, appearing on behalf of the Connecticut Industrial Energy Consumers, or CIEC.
Good afternoon, Tom Wheel from the Office of Consumer Counsel.
Albert Zablowski, also for the OCC.
All right. Thank you all for the introductions and for joining us today. And with that, we can begin just brief opening remarks on the relationship between return on equity and PIMS. And we can start with Eversource and again, work our way back around the horseshoe, please.
All right, good afternoon. Thank you for allowing me to speak to you today. My name is Alan Felsenthal. I'm a utility managing director with PwC. I'm here as a subject matter expert supporting Eversource Energy in today's technical session. I'm also here to respond to any questions related to the expert report prepared by Sean Riley, filed in connection with this hearing. Mr. Riley wasn't able to attend today's hearing due to a jury duty assignment. As a result, I will be sitting in for Mr. Riley. I'd like to start by highlighting the key points addressed in the expert report filed on November 6th, 2024, titled Performance Incentive Mechanisms, Return on Equity, and the Regulatory Compact. Key concepts that are discussed in our report are as follows. The regulated utility industry is a capital-intensive business, with such capital being sourced from both creditors and investors. Utilities compete with each other and other for-profit companies for that capital. Regulatory risk has a direct impact on cost of capital. The greater the risk, the higher the demand for returns. Therefore, in summary, our opinion is as follows. It is critical to retain the foundational principles of the regulatory compact. Most importantly, utilities need to have the opportunity, but not a guarantee, to earn authorized returns. Utilities need to have full cost recovery for prudently incurred costs and fundamentally need rates based on costs. Such costs to include actual expenditures, cost of debt, and cost of equity. ROE should be set in the traditional manner and PIMS should be on top of this, with such PIMS being symmetrical, i.e. both downside and upside risk. In our view, divorcing rates from costs is out of bounds. If this is done in Connecticut, the state would be viewed as a clear outlier with regulatory risk greater than all other states. And this would directly impact both the cost of capital and the ability to attract capital in the future. In other words, there would be consequences to disconnecting rates from costs. And finally, I'd like to make a comment with regard to last Friday's news regarding the downgrade by S&P related to Avangrid's Connecticut gas utilities. First, one has to assume that Eversource is next in line for a downgrade. S&P was harsh in its critique of the Connecticut regulatory landscape and pointed to rising levels of risk in a continuing unproductive regulatory environment in Connecticut as a basis for the downgrade. Clearly, this will drive up the cost of capital. In my view, Connecticut has lost any flexibility it had to withstand a PBR structure that colors outside the lines, i.e. not consistent with the regulatory compact. If the PBR structure in Connecticut is not changed to avoid punitive rate case outcomes, disallowing capital cost recovery, to avoid disallowing a recovery of valid and prudently incurred costs, and to avoid setting the ROE below market, then I can't imagine how negative the impact might be to the citizens of Connecticut. More importantly, I believe you are seriously jeopardizing the utility service within Connecticut in the future. Ultimately, it will be a situation where costs will increase while service will degrade due to constraints on investment. Essentially, a downward spiral that will be difficult to control. Thank you.
Thank you, Mr. Felsenthal. And just to respond to that point, that I totally understand the connection you're making here with the credit rating point. I do want to keep the conversation generally focused on the future and looking at PBR specifically in relationship to PIMS. So I appreciate the comment, and I'm hoping we can look at sort of constructive how we're considering the PBR landscape moving forward. Thank you. Attorney Rothenberger.
Thank you very much. I expected we would have a robust debate on this topic, and we're off to a roaring start, so thank you. I appreciate this opportunity to set forth some preliminary thoughts as part of the introductions to the topic of utility return on equity under a PBR framework. At the outset, I think we need to underscore the distinction between a reasonable opportunity to earn the approved ROE versus a guaranteed ROE. And I think sometimes during our discussions, that distinction gets lost. We understand certainly that the utilities have a fiduciary obligation to their shareholders, but shareholder compensation and expectations must be reasonable. Rate-making principles require that rates be just and reasonable, but, and this is important, no more than fair and reasonable to meet their obligations. These rates must ensure the ability of the utilities to provide safe and reliable service to their customers while providing for the ability to meet future demand. And the entire point of PBR is to encourage the utilities to meet these service obligations under the existing public policy framework at the least cost. That is how utilities can earn a reasonable return. With respect to the ROE, we believe that performance metrics should reduce utility risk in that the utility has more certainty regarding what the regulator expects to reward, and this reduced regulatory risk can then be reflected in the ROE. Moreover, the upside opportunity presented by performance incentive mechanisms that reward the achievement of public interest goals creates an added opportunity to satisfy shareholders with higher earnings per share and earn access to affordably priced capital, even if the underlying rate base reduces and even reverses its historically an inexorable upward climb under the so-called regulatory compact. And I'd like to turn it over to Carl for a few additional comments. Thank you.
Yeah, I just want to make a couple of points about the posture of PBR in the context of talking about the return on equity as well. And we look at things like the recent Moody's report that was cited in some of the comments. We see discussion about cost recovery delays, disallowances, lower than authorized returns. We also see comments about contentious regulatory strategies and counterproductive investment decisions, as well as rate case parameters that may provide sort of or present a stifling situation. And the main point I want to make about that is that each and every one of those is susceptible to being addressed through a PBR. And one of the things that didn't show up in the comments prior to this technical session was the fact that this ex ante understanding of the terms and conditions for successful earning, not just simply, amassing or being awarded, but actually earning return on invested capital, are all addressed in such a way that the things that count as negative in the traditional financial analysis mind are significantly reduced, if not entirely obviated. So we have the chance to recast the relationship in a positive way in which expectations are set, like I said, on an ex ante basis. And I think that is the biggest source of this reduction of risk that we discussed in our comments. Thank you.
Thank you, Mr. Abigail. UI?
First, thank you, as always, for the opportunity to continue contributing to this discussion. We have several comments on this matter. First is, as we described in our written comments, PBR should not foundationally alter the approach to setting authorized ROE, a perspective expressed by many participants in this docket. Hope and Bluefield, longstanding foundational Supreme Court cases indicate that any cost of capital established in the rate-making proceeding should be adequate to allow the utility to attract capital commensurate with the returns offered on other investments of comparable risk and sufficient to assure the financial integrity of the utility. And none of that changes with PBR. Second, we think that performance incentive mechanisms should be included within the ESM calculation as we described in our response to UPA 24. The ESM is an important indicator of the utility's financial strength, and we think excluding PIMs from that calculation doesn't make sense and it will send improper signals to the market. And then third and finally, as parties have expressed in written comments and as Save the Sound just expressed in their opening statement, some parties have suggested setting the authorized ROE lower than it might otherwise be set, and then using performance incentive mechanisms as a mechanism to allow the utility to build back up to their authorized ROE. And we have several problems with that. First, I think at that point, a performance incentive mechanism is no longer a performance incentive, but rather is effectively a penalty. We question whether that approach is aligned with the PIMs that are being selected currently or appear to be honed in on in REO2. And we look forward to understanding the perspective of Save the Sound as to how the implementation of a performance incentive mechanism in one area of their business would reduce or erase the level of risk in the rest of the utility's business to potentially allowing a risk-free cost of capital that is illogical, nonsensical, and potentially devastating to utility operations if adopted. So we look forward to exploring those topics further today.
Thank you. Attorney Goodman?
Thank you. CIC continues to have concerns generally with respect to the developing PBR framework and with respect to the question of the relationship between ROE, PIMs, and revenue requirements. As expressed in our comments, we have concerns, different concerns, but whether the PIMs are, as Mr. Hurwitz just said, if the ROE is set lower than otherwise it might be, and the PIMs are used as an opportunity to get up to what the allowed return would be, have concerns about the increased risk of financial impacts to the companies that potentially ultimately could result in increased cost and or degraded system reliability to customers. If PIMs are incremental to ROEs, our concern is that for them to be material enough to, or let me restart, if they're set at a level that may be material enough to really encourage the company for exceptional performance as an additional shareholder incentive incremental to rates, that could have an adverse impact on customers. And if they're not set at that level, but set at a level that is perhaps more affordable for customers, it may not be quite enough to incentivize the conduct that the authority is looking to incentivize. So I realize that all I'm doing is pointing out problems and concerns, which I know is what we're here to do today. But we continue to not see a clear way to thread that needle, at least based on what's been discussed so far. Thank you.
Sorry about that. That is your 3 minutes, Attorney Goodman. Thank you. OCC.
Hi, Tom Whale from OCC. We agree with Eversource's statement that the greater the risk, the higher the expected return, and the inverse also being true, that the lower the risk, the lower the expected return. And we think that, I think as indicated in our comments, that in determining the appropriate cost of equity in a rate case, the authority can, and in fact has traditionally considered the subjective risk of a particular company, even in the context of its regulatory environment, in determining what the appropriate cost of equity is. We actually just filed an interrogatory response in this docket today. I think it was only directed to us. It isn't specific to PIMs, but we did raise a couple of somewhat recent PURA decisions and a couple older ones too, dating back to, I think, 2008, where PURA did just that. It evaluated the evidence presented by the cost of capital witnesses in the rate case, but then also considered things like revenue decoupling or capital trackers in the authority's determination, downward movement on the risk the companies subjectively faced, and ultimately set the authorized ROE to that level. So I think that all that being said, I agree with Mr. Hurwitz. I don't think that there's anything kind of systemic or structurally that needs to change as a result of this proceeding. I think PURA is already equipped to and has been able to account for these same sorts of things in the past. And I think PIMs, any PIMs that are authorized in a rate case would just be put into the same kind of put under the same kind of consideration by the authority in setting ROE. And I have a lot more to say, but I'm cognizant of my 3-minute deadline. Thanks.
All right. Thanks everyone for the opening comments here. I think it sets the table for the discussion, and to get into some questions, I'm going to turn it over to Mr. White with attorney staff, and we'll get started.
Thank you. So I'd like to touch on MRP related risk at first. A question for UI. In your November 6th written comments, the company raised concerns that MRPs increase risk. Does that risk relate to uncertainty?
Yes.
Okay.
I can leave it there, but I can also say more if you would.
You can if you want.
Yeah, multi-year rate plans do increase risk, and I haven't pulled up the exact quote, but I think we were citing to some testimony from staff for the New York Public Service Commission that indicated that multi-year risk plans in that state typically come with, I think, 30 to 50 basis point ROE premiums, because the utility there has to take on the risk that not only might interest rate conditions change over the course of the 3-year rate plans that are typically approved in New York, but so too is the utility taking on inflation risk or forecast risk, or elements that risk that elements of the amounts underlying the approved revenue requirement might not end up comporting with reality. So yes, ROE is compensation for risk, and the reason New York staff has in the past awarded a higher one for utilities entering multi-year rate plans is in recognition of that increase in risk.
Thank you. So a question for OCC. If the risk relates to uncertainty, can an MRP be used to reduce uncertainty? For example, if no costs over a 4-year MRP were known, that's a significant risk. Conversely, is it fair to say that if 100% of the costs over 4 years are known, then there is no uncertainty or presumably no risk or very little risk to the EDCs?
Yes.
Okay.
I think I feel like I say this a lot in this room, but I think it all depends. I think it so much depends on the details. I think the risk inherent in any multi-year rate plan depends on what's being ultimately authorized in that multi-year rate plan. I mean, I think a single rate year, as has been traditionally authorized historically by PURA in the past, in some circumstances, can be much riskier for a utility than some of the multi-year rate plans that have been authorized by PURA in the past, because it depends on, I suppose, the circumstances of the case and whether the authorized level of revenue, how close that authorized level of revenue is to the actual amount of revenue the company eventually will need. So from my perspective, I don't think it's fair to say that multi-year rate plans in and of themselves present more risk than a single year rate plan. I think that all the details of the rate plan itself need to be considered.
Thank you. And would those, just curious, those details, would it include O&M costs? So if you look at O&M, if you see O&M costs as a function of rates and units, for example, labor, you have FTEs and you have a labor contract. Let's say that contract is 4 years. You'd have a pretty good idea of what your cost would be for 4 years. Is it possible for an EDC to have a reasonably good estimate for their future cost?
Yes. I mean, that's a pretty good example. I think to be charitable to the utilities, it's possible that in the case of a multi-year rate plan, despite having a labor contract, that something outside of the utilities' control could arise that would create the necessity to hire more people. I think that kind of thing, though, could potentially be resolved through some of the other rate-making mechanisms we've discussed in this docket, or generally from things like off-ramps that we've talked about. So again, hate to bounce it back again and point to the specificity of what's in the rate case, but I think it really does come down to, I think the level of risk as to any element, whether O&M or capital, really depends on what's being requested, what's authorized, and what the circumstances in front of the utility and the regulator look like at the time of the rate case.
Thank you. Anyone else?
Yeah, I'm thinking about what your response, Mr. Hurwitz, and the uncertainty of a multi-year rate plan, and I think what you're suggesting with how New York staff positioned it and how the company cited to that language in their comments suggests that there's no a comment Attorney Wheel just made about guardrails, that there's not, or even off-ramps rather, that would be the case, that there would be that uncertainty if there were no, or if there were rather a stay out provision, that the companies would not file another rate case during the term of an MRP. And I can appreciate that. And I'm also curious, because it's not my recollection that either company has proposed a sort of a defined stay out provision here. So is there the same level of uncertainty if a stay out provision is not considered as a part of, or is not, I should say, is not adopted as a part of the PBR framework?
That's a great question, and I'll just take this opportunity to take a step back and also agree with Attorney Wheel of OCC. I think that, to paraphrase a sports commentator, situations are situational. And I think here, almost regardless of the other elements of a PBR plan, the fact that there is a multi-year rate plan has one effect on the risk profile of the PBR plan overall. But to the point of your question and the question for Attorney Wheel a moment ago, it's not going to be the only one. There are going to be other elements of PBR that also interact with, its effect on the risk profile of the utility. One example could be the ESM. For example, the Hawaii PUC approved a symmetrical ESM with a 300 basis point deadpan, and the decision had extensive discussion about the risk-reducing benefits of that earnings sharing mechanism because it mitigated the downside protection to the utility. And so my point in going to, providing a multi-year rate, or reflecting a multi-year rate plan in the implementation of PBR increases risk, is not to say that, this is some unsolvable problem or there's no other fact that might counterbalance that, but rather this is one very real, very valid consideration. And I think that type of analysis of all the elements of the PBR plan as a whole would have to be involved in the determination of an ROE in a PBR-based rate case. And I know we're probably not looking for us to continue harping on the straw proposal, but if the form of PBR looks like that, its effect on the utility's risk profile would be very different than, say, the PBR plan of Massachusetts or Hawaii or any other jurisdiction. And so that's kind of what I was trying to get at, if that helps.
Yeah,
If I've
that
missed your
does help.
question,
And so then would you suggest that the MRP, or the presence of a multi-year rate plan within a PBR framework does not inherently determine the level of risk?
Well, I think all else equal, as New York PSC staff, and as we said, that is one element that would otherwise increase the risk of PBR, because we're having our rates set for multiple years at a time. And as we've indicated in the past, if the rates that come out of a PBR-based rate plan are not just and reasonable, we would not be able to stay out, but it still takes well over a year to prepare and then litigate a rate case. So I don't know that that is like a perfect switch that solves the risk increasing attributes of a multi-year rate plan, if that makes sense. Like, the mere fact that we might retain the option to file doesn't intrinsically erase that risk.
Attorney Goodman.
Thank you. Given the discussion of the New York PSC and the risk premium that can be added to an ROE and a multi-year rate plan, just want to add a little context if I can. In New York, if a rate proceeding is litigated, the PSC will only ever issue an order for a one-year rate plan. To get to a multi-year rate plan in New York, it has to be negotiated settlement between regulatory staff, the utilities, or utility rather, and whatever other parties will sign on to it. So in the context of a multi-year rate plan, if there is an ROE adder included to address the stay-out risk, if you will, that was agreed to because in the give and take of negotiations, staff and customers decided that the complete package of the negotiated terms were reasonable, inclusive of that additional risk. In other words, it's not say an ROE adder that the PSC will just hand out in recognition of increased risk. It's something that is negotiated under certain circumstances.
Thank you for that additional information, Attorney Goodman.
If I maybe just briefly to comment, because Mr. Kramer, you mentioned that the utilities hadn't been considering a stay-out provision. And from Eversource's perspective, we've been consistent that a stay-out provision is a necessary component of performance-based rate making. I know that wasn't an element of the straw proposal, but I guess I was holding on jumping in because as you're talking about a multi-year rate plan, I think we are talking about what was defined in the straw proposal, unless is there something else that I'm missing? When you're talking about a multi-year rate plan, are you talking about a performance-based rate making framework like that which was outlined in the straw proposal last November? Or are you talking about something else, like going to forecasted test years in a multi-year rate plan, or?
The former.
So talking about the performance-based rate making framework of a, right. So I guess I would agree with the other comments which have been said, which is that it would depend on how all of those other elements are resolved, whether and to what extent that changes the risk profile during the course of the PBR term, including whether the utility retains the right to file a rate case as it needs to. As we've looked at it, provided that the foundational principles that rates are set based on utilities costs so that it has an opportunity but not a guarantee. We've never argued for a guarantee, an opportunity that the rates are structured in a way that we can recover our costs, including an ability to earn the authorized ROE in any given year. Then I think it will just come down to how is that being set in a rate case, and then what is the rate change that will happen over the course of the PBR term or the multi-year rate plan, which again, in the straw proposal, would only conclude and confirm that we can't recover our costs because we've been held to having no post-test year adjustments for post-test year changes to expense. Depreciation will be set at the 13-month historical average. There will be no X, despite what the science may say about the value of what an X needs to be, so that rates can track with the utilities costs over the course of the multi-year rate plan, and there will be no supplemental capital recovery. So all those things being predetermined by the straw proposal as it's currently constituted, that will significantly increase the utilities risk, especially if it comes with what is traditional as part of a PBR framework, which is that the utility is barred from, or at least voluntarily foregoing its right to file a rate case when its rates become out of alignment with its costs. If we don't have that as our recourse, then absolutely the risk is going to be significantly enhanced and increased. And I think that's where I understand and I agree we should be looking ahead, but the rating agency actions, which are saying that the Connecticut regulatory environment is anti-utility infrastructure investment, downgrading by 2 notches Connecticut's gas utilities, is sending a very strong signal that the PBR framework is just one of many things that needs to be built correctly so the utility has that opportunity, and the level of uncertainty and risk that is inherent in the Connecticut regulatory environment today is just creating more problems and concerns that you certainly can't, or I can't, assume that the PBR framework is going to solve anything, is going to result in less risk. Again, I'm thinking and looking at the straw proposal, which is the foundation that all this discussion is being tied back to, and it is not reducing any risk. It is only increasing the level of risk.
Thanks for that, Mr. Horton. Mr. Robigo?
Yeah, just to add, thank you. Yeah, just to add a couple of comments into this general discussion. I think it's important to remember 2 things. First of all, I think everybody agrees that we assume that the the PURA will sit down and adjudicate what it believes is an appropriate return on equity when it sets the going-in rates under this PBR model. And everybody, I think, agrees that we'll use the same general approach, which is that the various parties will advocate for the particular model that they like, usually based on what kind of numbers it'll get you. And then we'll look at those numbers and we'll all argue before PURA about whether we should be at the low end or the high end of what looks like the reasonable range, maybe with some adjustments to the models based on assumptions. It's important to remember that the straight up same way we apply things like CAPM and DCF and the other models that are often proffered may not actually be appropriate under a PBR world. And that's something I think the commission, has to look at, has to ask itself is, if utilities are a little different from the rest of the market, how much more different are they if they're operating under PBR? And does that increase or decrease the risk? That's ultimately what we're going to do. But the important two things that I wanted to mention was, number one was, first, we're going to be doing this in the same approach. And by the way, the utility people will come in and they'll say, yeah, they're out for 3 years and they have stability on their rates for 3 years, but everybody has that, so that's not a differentiator. The risk is the same. We've read that testimony, dozens, some of us maybe more than dozens of times. And then other people will say, yeah, but they don't really have much risk. Some of us will make that argument. Risk has been reduced because they know this, they know that, there's a plan, they know what they have to do. That's what we said in our comments. But the second most important point I think that we should keep in mind is, in addition to sort of growing by chunking, doing this, looking at the various components of whatever PBR regime is adopted and assessing those just like we do ROE, where model results and risk factors and all that stuff are all piled together, and then the regulatory decision is made, is that we're going to learn by doing. This is going to be, at first, maybe the composite differential in risk is not going to be that great because there'll be ups and downs. We don't know how well the utility will perform under some of these conditions, or whether it might outperform or underperform, how it's going to perform. We don't know. We don't know how bad things like climate change and other factors are going to be and how wild they make things, or whether new technology breakthroughs, all that other stuff. So my guess is that we're likely to see an ROE that pretty much comes in where the ROE for other utilities going through these transformational processes are experiencing, and then you'll just get better at it. In each iteration of setting these going-in rates, you'll realize what really makes a difference and what doesn't make a difference. So we don't have to do the perfect right now. We are pretty comfortable with the approaches we've used. We know how to value the outliers that PBR is going to introduce. We're not changing everything all at once. And so if what would really make us happy is if the entire process, instead of relying on rote exercises using averages of the companies that I prefer versus the companies you prefer in a particular proxy group, would actually turn into a much more disciplined assessment of risk. Because then we really can start approximating the ultimate that we proposed in our comments, which is that we could start with the risk being well managed in performance metrics and the base load function being a pretty risk-free operation for an electric utility, with all the other things being sort of gauged on top of that. So anyway, I went on too long, but.
Mr. Robb, may I ask a question just to try to understand? I'd love to track where you're going with this, and I'm getting lost a little bit, I think, in terms of how it would be implemented. When you're talking about things as if we'll kind of see how it goes, we'll figure it out, this is a little bit of an experiment, but everything will be fine, PBR is not going to be a problem. Are you saying that in relation to the straw proposal that is out there, or are you speaking more generically about performance-based rate making as a concept?
So disagree with everything you said I was doing in the first part, so we'll just wipe that off the record. But yes, in answer to your question, it's both, actually. What I'm saying is that the regulatory process of determining the appropriate return on equity is typically an analysis of what do the models show, which are not very jurisdiction specific. And then we will look component by component of the things, whether they're in generic PBR or whether they're in no, they'll actually be under whatever specific regime the final order dictates, which is may or may not bear any resemblance to the straw proposal, and look at each of those components. And everyone will have an argument and the ability to make an argument about how those components affect things, like a stay out period of 3 years with no opportunity for off ramping. Okay, that has a risk profile. What do we think that is? Is it big or is it not? Right? Is it, and and the very next thing, there is an earning sharing mechanism. How deep, how high before it kicks in? We'll assess the risk associated with that mechanism. This is standard financial expert ROE testimony. For models, what they tell us, and then risk factors that are unique to this utility, and then a judgment made by the regulator. I think that's the only way you can handle.
And so we might agree. I think, I mean, I've been
Yeah.
involved with many rate cases and understand that. I think what you're saying, if I could try to paraphrase to make sure I'm tracking, and maybe I got it wrong the first time, is that in your view, as part of a rate case, in setting the way the base ROE will be set, it should be based on that debate that will happen. The utilities will put on their case, everyone will challenge that case, the regulator will decide, and in deciding the base ROE, we'll also evaluate the structure of PBR that may or may not be implemented, including all the details, the stay out, the off ramps, the earning sharing, everything.
Right.
So I think that you and I agree on that. I don't know that's what Pura thinks, and I would love to find out. This is one of the conversations, a common thread through all of these was that I think in Attorney Will, we have agreed in prior technical sessions as well that we think should be the case. I actually think whether or not that is the case is the subject of today's technical session, and perhaps Pura is contemplating setting the base ROE differently. We don't know. As Mr. Kramer said, that wasn't outlined in the straw proposal. But as I come back to again, I agree with the foundational principle which you said, which is that the base ROE needs to be set taking into all those things into consideration. None of us sitting here can say whether or not that base ROE needs to be set higher than the peer group or lower than the peer group because of the relative risk that PBR introduces.
It goes even further. The peer group should be utilities under PBR.
And with a PBR
Right.
framework, or at least adjusted for the framework that's
go.
implemented here. So again, I come back to, I'm just too black and white, I'm a rule follower. The straw proposal says that PBR will be structured in a very specific way. And I have been operating since that time through all these technical sessions in good faith, trying to get to a good place to move forward. And again, respectfully, I hope that we can, but right now, as I look at it, I can't sit here in good faith and say, things are gonna be okay and we'll figure it out along the way. I think we're at a very precarious time right now to take with a leap of faith that the PBR framework that will ultimately be adopted is certainly not being viewed by external parties as it looks at Connecticut, saying that this will be a fair and balanced outcome to enable infrastructure investment in the state of Connecticut. Right now, the spotlight on the Connecticut regulatory environment is such that's not what investors are expecting to see. And we've highlighted repeatedly the shortcomings in the straw proposal. I do agree with general sentiment that performance-based rate making as a framework can do everything that you said, I think. I don't know about the risk-free, utility. I don't understand that concept, but I think the structure and the framework has promise, but it needs to still be found based on the foundational principles that a utility has an opportunity to recover its cost of service. The PBR framework needs to provide that throughout the pendency of the term, and then aligning our incentives, aligning our operations with those of PURA, meaning the priorities of PURA. I think that's the promise of PBR. But the straw proposal that cuts out the things that I have listed and said repeatedly in these
Mr.
doesn't do
Horton, I have both
that,
of
doesn't
the
give
same
that
ability.
foundation.
Gentlemen, I'm
Infinitely
gonna
long
interject.
I'll just wrap by saying, and yes, that's why earlier on, I made the comment that, the view of rating agencies, I made the comment that at least at this stage in our comments say that several of the things that we're looking at and that are in the straw proposal, that are in PBR in general, address the very things that the rating agencies say give them concern. So I feel optimistic, and as a result, if I had a crystal ball, I'd guess the appropriate ROE would be lower because the risk has been reduced.
Thank you. Thank you for that, Mr. Robigo. Thank you, Mr. Horton. I do want to bring us back to some questions, again, related to risk that Mr. White's going to continue to roll out for us here. So Mr. White, can you take us to the next question, please?
Thank you. Another question for UI. Staying with the general concept of known and measurable O&M costs, reducing risk, the company's November 6th comments referred to Alberta's K-bar stating, quote, consistent with the overall intent of PBR to manage costs on a holistic basis, the distribution utilities have the flexibility to use funding provided under K-bar for any capital project or even to divert to O&M activities, end quote. Could the company speak to what O&M activities might be covered? Would it be anything and everything or limited in some way?
Subject to check, I think you may have been quoting a reference to the Alberta regulator in our discussion of the K-bar mechanism, the first of the two prompts in those written comments. And I think what we were trying to say there is the Alberta regulator recognized that PBR provided the utility with a financial incentive to spend less, not more. And what they were saying is K-bar provides the utility with, and I forget exactly how they phrase it in Alberta. I think they call it an envelope of funding. In Alberta, the regulator recognized that K-bar provided the utility with an envelope of funding, and its management would have a financial incentive to invest that optimally. And I think they, in the quote you're reading, they say they expect that distribution utilities will continue to seek out ways to decrease costs through optimization of their existing assets, whether through implementation of non-wire solutions and operating solutions and through modernization or automation of their systems. What they're saying is K-bar provides an envelope of funding. We're not trying to authorize this project or that project or this other project. Rather, then it's on the utility to deliver the level of performance that we're expecting in PBR. So I might be missing the point of your question, but I think that's my understanding of what the Alberta regulator was trying to get at, and that's what we were bringing it in to our comments for, because I think the first prompt was about what if a K-bar mechanism produced 100 million of funding, but then the utility went off to spend 200 million. And so the point we were making, and I think this is reminiscent of points made in Save the Sound's written comments, is if that were to have happened, there must have been some significant business event necessitating that investment, because the utility's financial incentive would be to do the opposite.
Okay, thank you. To Eversource, does the Massachusetts K-bar allow for funds to be diverted to O&M activities, similar to what UI was just saying, or in some other way?
It does what Jacob was just saying, which
Okay.
is that Massachusetts, the performance-based rate-making framework provides level of revenues that is needed to run the business. And so the K-bar revenue support is based on actual capital additions. But the idea of PBR, and we've, again, been consistent on this point as well, is that the whole idea of it is to provide the utility with a level of revenue so that it can run the business and do so efficiently. And whether it's a capital expenditure or an operating expenditure, the goal and the promise of PBR is to have the trust in the utility to go and deploy the resources as efficiently as possible while it's in the course of the PBR term. So it would be not as opposed to like a capital tracker where you're providing a level of revenue support that is only tied to the level of capital spent. PBR is supposed to be and intended to be giving the utility enough, but not too much so that it can sustain the business between rate cases.
Thank you.
Just to reframe the question though, is it the case that in Massachusetts, the K-bar is like that envelope of funding for the K-bar is exclusively tied to capital investment, or it is not? The DPUC allows it to be spent on O&M costs as well.
So just it's maybe a fine point. I might be missing the detail of it, which is that the DPUC doesn't control how dollars are spent. The DPUC controls how revenues are set, same as PURA. So we get a level of revenues provided from the PBR framework, which is I minus X on our O&M related cost of service. And then it says an increment above that for the K-bar, which is based on a formula that says how much has actually been spent on capital over the last 5 years, inflated to the rate year, give you in figures out how much in addition to the I minus X formula is needed for that capital support. That produces a level of revenues. So the formula is based on actual capital expenditures, but the way that we spend the money in any given year is based on what is needed for the system. It could be capital, it could be expense.
Thank you. I think that answers my question. So it is in fact flexible funding because it's, as you're pointing out, the revenue to run the business, not necessarily that it is exclusive to capital.
That's right.
Thank you.
The next question is for you. So you're talking. To UI, I'm referring to the company's written comments for November 6th. UI quoted the New York PSC, which stated, quote, "By agreeing not to file for new rates for 3 years, the companies reduced their ability to adjust rates in response to changing conditions. Accordingly, locking in rates for an extended period somewhat diminished the company's flexibility and thereby increased their level of risk," end quote. What might be examples of those changing conditions, and how might the risks for such changing conditions be mitigated?
So this was testimony from staff of the New York PSC, and I cannot know with certainty what they were speaking to. I can take an extremely educated guess that they were thinking of a handful of things, including interest rate conditions. You know, you're setting the cost of capital today in anticipation of what interest rates will be over the term of a 3-year rate plan. And that's, you might have great evidence of what the market expects in the future, but you don't know what will actually come to pass. I'm guessing staff for the New York PSC was also contemplating inflation, as there's an inflation element that permeates many of the revenue requirement work papers in New York. And they were probably also contemplating non-inflation O&M costs that don't fall under reconciliation mechanisms. For example, labor expense, the company has a downward reconciliation if it hires fewer people than are contemplated in its rate plan, but not numbered one in case it hires more. So the company bears the risk that there might be some change in how it's required to operate that necessitates it to onboard more people that are not reflected in rates. And so I think it's costs of those types that the New York PSC staff was getting at if I had to take a guess.
Thank you.
And I think as to your second question, how might those things be mitigated? I'm guessing you're thinking that there are elements of those that will be just naturally mitigated through the design of PBR, for example, the inclusion of an I factor in the formula. But that's, again, situations are situational, and taking one sliver of risk down is not the same as completely eliminating the risk. So we would still bear, for example, the risk that interest rate conditions could evolve and our required cost of capital in year 4 of the rate plan ends up being higher than the one we compute at the beginning of year 1. Or there are going to be elements of costs that are not specifically tracked in PBR. I think that is not just a possibility, but the promise and the explicit purpose of PBR is that in rate years 2, 3, and 4, I think it might have been Attorney Wheel who said we are required to take that leap of faith and say, you know, we're not setting rates based on the specific collection of cost forecasts, but rather designing an overall bucket of cost. And so there too, we being the utility, take the risk that that amount of funding ends up being insufficient. And unlike the utilities operating under PBR in Hawaii, we don't have downside protection from an ESM. And, you know, we don't have a capital funding mechanism, at least not one that was contemplated in the straw proposal. And so are there things that can be done to, you know, respond to the risks that the utility takes on in a multi-year rate plan? Of course. But I think, you know, adding in a couple of those or some of those or even a comprehensive package doesn't by default erase them. I think as Mr. Robigo, you said it, when setting the ROE, my expectation is that we as a whole would spend a lot of time arguing about how all of those factors together impact the authorized ROE.
Thank you.
I'm curious, just as a follow-up, Attorney Wheel, Mr. Abigo, Mr. Horton, if you have anything you want to add about potential mitigants to those changing conditions, and not, again, to a comment you just made, Mr. Hurwitz, not because the goal is to eliminate risk necessarily, but that's not possible. But there are choices that could be made in terms of PBR design that address some of that.
Sure, Tom Wheel again. Yeah, if we could eliminate risk, that'd be cool, because then we wouldn't need ROE at all. That would be great. Yeah, I mean, I think I don't disagree with anything Mr. Hurwitz said. I would add that, like, maybe I've been thinking of this, maybe not everyone's been thinking the same way, but I've been thinking about the difference between what we've been discussing in this docket and what we've historically done in Connecticut in terms of multi-year rate plans. So historically, we have had multi-year rate plans that have been based exclusively on forecasts. We've just never done this an index style arm before. And I think that there are different risk profiles between those two models, but I can also see them going both ways. I mean, I think from the consumer's perspective, there was risk, too much risk, perhaps on the consumer side in the old model, because if you just set those, let's say it's a 3-year multi-year rate plan, you set those 3 years using forecasts and those numbers are locked, and then inflation goes the other way, then customers bear all of that risk. That being said, the same utilities continue to bear an equal and opposite risk that things will go the other direction. So I guess what I've been thinking is this model, multi-year rate plan that's indexed to inflation or indexed to anything, more risky than what we've done before? And it seems to me that it wouldn't be, because you eliminate that risk of variance of what happens, at least with respect to inflation. Maybe it doesn't cover interest rates or other kind of financial conditions, but it does seem, at least in my mind, if you're just comparing those two elements of the multi-year rate plan, that an ARM would ultimately be less risky.
I'll jump in. I mean, I take some comfort first in the core concept that a lot of utility spending is long-lived. And so it's well understood. Depreciation schedules are relatively stable. So as a result, amortizations are, fairly predictable, and a huge bulk of the system, like, T&D is well planned, planned out a long ways. So that just the basic composition of the utility business itself does not have me worrying a great deal for 3 or 4 years of a multi-year rate plan, especially given the fact that the way we do this ultimately goes to historical costs anyway. This is a long-standing tradition of the utility business. You look at a set of historical costs and you either use those as a test year or you extrapolate them as a future test year. But one way or another, it's a bunch of historical costs, and utilities are highly skilled at understanding where they think those costs are going given the forecasts they have. A little bit of a wild card on some of the way we do forecasting. Things like weather-driven and weather normalized doesn't seem to make sense in a rapidly warming world, but maybe we're not allowed to talk about that, so we don't have to worry about it anymore. I also take comfort in the idea that there are special accounts. There will be severe weather accounts. There will be accounts and that are places where we will pool money for special issues that have different profiles than those long-lived, well-planned, reasonably predictable kind of spending accounts. There is, of course, going to be potential upside for PIMs, which will mitigate against this. And finally, there is, I think, a latent X out there. I think we all believe that there's an opportunity for some efficiency and productivity improvements that will also counterbalance that. And then finally, Eversource's attachment 1 shows how you can, in their little model, and we'd have to have lots of debates about all the assumptions and stuff, but even in their little model, made a 25% difference in, what sort of would have been the rate shock under the hypothetical $100 million example, just by making some different assumptions about ways things were treated and what allowances were provided during the multi-year rate plan for adjustments. So that's pretty good headroom, 25% between the difference between that 8% number and that 6% number in terms of that hypothetical rate shock. means there's some levers that the final order, on implementation of PBR can help address.
Thank you. Mr. Horton, do you want to add anything on?
I think the original question was getting back to, in a multi-year rate plan, what are the ways to mitigate risk to the extent expenses vary from costs? Is that?
Yes, and I think specifically from the perspective of changing conditions, right? Changing conditions over the multi-year rate plan. So that does ultimately come down to costs, how they would affect costs. How can those be mitigated?
So originally, if the question is like, what is unforeseen circumstances, we don't need to look too far into our history to see COVID-related impacts that nobody could have foreseen, which had long-lasting impacts on supply chain, which still are having residual impacts, and have also resulted surely in inflation that has not been, contemplated in a rate plan that would be based on forecasts. In a PBR framework, if GDPPI is the measure, then you'd have some recognition of inflationary changes over the course of the PBR term that would get into it. But I think there are lots of things that affect the utilities business that can't be foreseen at the time of a rate setting in an operating environment where we're not putting forecasts into rates, but have a strict known and measurable standard for what's going into the cost of service. It almost doesn't matter. Like, we could forecast as best we can, but if that's not what's getting into rates in some form or another, I guess I see there is risk. And again, getting back to the straw proposal, a forecast, even if we had a crystal ball, wouldn't be making its way into the utilities rate structure because known and measurable changes are barred. So now I'd say if we're in a hypothetical where a PBR framework is adopted, that would be in the traditional sense. So you'd have inflation with an X that's decided in the rate case and based on a methodological basis. So that sends a trajectory to say, here's what we expect the average industry participant, the average utilities cost trend to be over the course of the PBR term. Like, now we're talking. Now we're at least having a methodological basis to set the level of revenues over the course of the PBR term so that the utility will have an opportunity, but not a guarantee, to have a level of revenues in place that match its costs over time. There are always going to be unforeseen circumstances, though. Emergent system conditions, system fail or equipment failures, changing regulatory or legislative requirements, inflation, credit downgrades. There's a myriad factors that impact the day-to-day operations of the utility that I think at the end of the day, we're trying to get to a PBR framework, or I hope we are, that gives the utility in any given year that opportunity, but not a guarantee, so that the rate trajectory is such that we can try to manage the cost trends over the course of the PBR term, manage our system, the cost of that system under the envelope of revenues provided for by the PBR term.
Thank you.
A question for Eversource, referring to the company's written comments from November 6th, attachment 2, which was from PwC. The company addresses how stakeholders would assess risk related to ROE and PIMs, suggesting certain questions and concerns such as, quote, stakeholders would specifically focus in on the structure of the PIMs, assessing the risk associated with measurement of results, timing of recovery, and other broad external factors or judgments that could impact the determination of the achievement of a particular PIM. Can the company elaborate on these other broad external factors or judgments?
I think all that's saying is, in the value of the stakeholder, investor would like to have an idea, are they going to be able to recover their costs and earn a fair return? And by looking at the various PIMs, is that reasonable? Is it reasonable that they will be able to recover such costs or not? Or is that put in jeopardy, which would in fact reduce the ability to earn the actual return? I think that's all that's saying.
And I agree. I think just to elaborate to some of the earlier comments and reading the comments that were filed on November 6th by the parties around the table, I do think that was a common thread. I don't want to speak for anybody else, but what I read through those comments was sort of what Mr. Rabago was saying, which is that the base ROE should be set at a level that allows the utility to attract capital. And we're going to debate around what that level should be, but that's the the way that it has historically been done is the way that it should continue to be done. And then PIMS would be fashioned in a way that sits on top of that. Again, I don't want to speak for anyone else, but that's at least Eversource's perspective, is that you have to have a base ROE and an opportunity to, but not a guarantee, to earn that authorized ROE. And then a PIM is just an added layer to give an increment above or below, for good performance, an incentive, and for poor performance, a penalty. But as long as that PIM is designed in a way that isn't going to tip the card over so that we don't have that opportunity, then investors are going to be okay. The second we start to either have outsized PIMs so that the risk is too great, that's when investors will voice their concerns. Or the second that they start to understand, oh, Pura is trying to set the base ROE at the cost of debt, for instance, and then to try to provide an opportunity to earn back to that level of ROE, they'll want none of that. The risk is too great. We don't get to tell investors to give us their money. They talk with their feet. And so if they're looking at Connecticut and evaluating it as being a relatively risky place to park its investment, they'll tell us that with their feet, and they'll choose other alternatives. They'll stay away from Connecticut. And that's what we're trying to say, is it really does matter is what the parties around the table, provided I'm summarizing it accurately, if what we're saying is true to what Pura is intending to do with ROE under a PBR framework or not, or is PBR intending to change and turn over how the base ROE is set and then provide some, ability to recover it under certain parameters. That's going to really matter to equity investors when they're choosing to give us their capital to invest in the system that serves our customers.
Yeah, I'm just going to say the example in the report says there's two investors, and one of them has an opportunity to invest and earn 9.6% return under traditional regulation. The other one says you can earn 6%, the debt cost, but if you do things right, you can get up to 9.6. People with that choice are going to pick the one with the 9.6 opportunity, not guarantee, opportunity, as opposed to the one that if everything goes right, they might get up to 9.6. Or as Mr. Horton said, if you're left with that choice, people aren't stupid. I mean, they're gonna choose where they're going to want to invest. And if the choice is 9.6, without a guarantee, but an opportunity to earn 9.6 or start at 6, and if everything goes right, get up to 9.6, they're going to go with the former.
I'll just add to that. In my opinion, I think the investor relationship will become a little bit more complex. If you think the status quo under cost plus regulation is that, did they spend enough that when multiplied by the ROE meets our EPS, earnings per share goal? Was that spending put into the books through regulatory approval soon enough that it helped? And was it approved as prudent? So it's that ball of spending and done, approved, and put on the books, and then multiplied by whatever that allowed ROE is. And that's pretty simple. The PIM question and the PIM quote does raise another level of concern. So for the investor who's only focused on this, did we realize the earnings that we thought we would realize? They also have to come to a view as to whether the utility will be able to do the things that the contract implicit in the PIM requires them to do in order to earn or stay level or earn more, or will they not have the managerial and operational capacity to achieve those results, right? And that is something new. That it bears explaining and articulating to the investment community that it's not just spending approved and put on the books multiplied by a formulaic number, but it's also the company's ability to divert, to focus enough attention and capacity to earn that additional reward. That could be really juicy for those investors. It's something on top. It's not unprecedented. We've had these kinds of things for a long time in the regulatory space. it also comes with the risk that if they don't perform, that they will get a penalty that will cut into that other calculation for the base rates. And that's interesting. What's interesting and unique about that is that there's sort of, you know, there's less ability, assuming that we've all understood what these obligations are going in place, there's less ability to point at the regulator and saying, you failed on letting us put this on the books and you failed on approving this as prudent and all that stuff. It's per the contract that was set in the PIM. It's clear to everybody up front. Again, another reason why we think it shifts risks off.
And I just add, I think in both the examples that we heard, you know, what I heard was the opportunity to earn the ROE of 9 or 9.6, whatever the example was. It was just in the case of the PBR example, there was a more clear roadmap to the utility about how to achieve that. Even under the current system, when you have an approved ROE, utilities over-earn, utilities under-earn. They're not necessarily hitting that target. So, you know, the framing of it, how we describe it, may be different. It may matter a great deal. But even under the PBR example, I heard the utilities having an opportunity, if everything goes right, to earn an approved ROE of 9 or 9.6. And that's really no different than the current system where, you know, things have to go right for the utility for them to earn their approved ROE today.
Just wanted to,
Oh, after you.
no, I thought Mr. White was pointing at you. I thought he was pointing at me, but you go first. Sure. Thank you, Mr. Hurwitz. I was just gonna say, I think I agree with Mr. Horton and Mr. Robigo, because I think the thing I agreed with Mr. Horton the most on was that we could debate the utility's actual cost of capital. So I think if you come from the perspective, as like maybe I personally do, that regulators nationwide have set the authorized rate of return on equity far higher than the actual baseline cost of capital, meaning the cost, the earnings that a utility company requires in order to access capital at all. If you have a debate about that, and then from there structure an ROE that can, as Mr. Robigo was saying, can capture, and as Mr. Rothenberger was saying, can capture the opportunity to earn some higher level of earnings. I think that we're all in a sense saying similar things, although I'm sure Mr. Horton would disagree with my statements about the overall cost of capital set nationwide. I think systemically, maybe everyone's saying the same thing, that you can start with kind of determining a baseline cost of equity and make adjustments from that level. But where you end up on that baseline cost of equity matters a lot.
And if it was okay, I was just going to ask if Save the Sound, you could clarify one particular quote from your written comments that I'm just struggling to connect with how you've described today. So on page 4 of Save the Sound's November 6th written comments is the quote, "Under a PBR framework with performance incentive mechanisms, the utility's authorized ROE for costs not addressed in the PIMs should be set at or increasingly near to the risk-free cost of capital for a similar utility business." What I heard you say at the beginning of this technical meeting, and I'm coming off a weekend of football and bad choices, so I could not have gotten it perfectly accurate, but was your assumption is PURA will adjudicate the ROE using the same general approach it's used in the past. And the question is just how different PBR makes the risk profile of the utility and how the various chunks of PBR factor in. Those feel like very different perspectives to me, and maybe I'm just misreading or misunderstanding, but could you just help me with?
Restate that conflict again?
Yeah, the quote was, "Under a PBR framework with performance incentive."
Okay, I got that part, but I'm saying your concern.
It seems like on the one hand, you're saying if a cost is not covered by a PIM, the cost of capital should be the risk-free rate. On the other hand, you're saying it should be set in the same manner it's been set in the past. And I just don't see how those two things.
Well, yeah, and with the premise, thank you. Yeah, the premise of that, first of all, is that's like extremely long-term. It's sort of maybe it's the lawyer or the litigator in me that look at the end result. Where does this thing take you over the long term? Where it takes you over the long term is that is a construct, which is that we are very clear and upfront about everything we want you to do, and or as much as possible, or that we care about, that we want you to do, and the standard for performance. And then the rest, and this is grossly simplifying, and it is not meant to be sort of a silly, but the rest is sort of just tightening bolts and pouring concrete, which I know is essential. You got to pour some concrete, you got to tighten those bolts because things will fall apart, or you got to re-pour concrete. But it's that we've articulated the places, the things, the many things you do that are most important. We said, this is the standard, and they're so important to us that we're willing to pay you extra or punish you, and that's a whole nother discussion about PIM design. But what's left is pretty much the sort of the bread and butter, low risk business, not going to face much competition on it. Enjoy a franchise. It's very predictable. All the things that make that very low risk, which in that extreme example, which, generations hence may not get to, we've distilled out the operational risk to the performance criteria, and we're left with just that piece that no matter what happens, you're still going to do, and you're not going to know how to do, and you're going to do very well because you've done it a million times, and it's not going to change, or it changes predictably. So that's the thesis there, right? It's exactly the same thesis that all the utilities and everybody articulated, and it is used in all the fundamental ROE setting models, right? Which is a start from the risk-free cost of capital and then add the risk factors above. And what I'm saying is, if you move that layer over to PIMS and performance standards, then kind of what's left is the risk-free cost of capital, with the important caveat that we're talking about for somebody doing a utility business. So that's my best. I hope that helps.
Oh, that's very helpful. And I had one more follow-up question, if that was okay.
Yeah, one more is fine, and then we'll move on.
I struggle with how a PIM can reduce the utilities risk, and I haven't been as involved in REO2 as I know others have. But to use an example, I think one of the PIMs they're contemplating is avoided service disconnections. And I understand if we meet some benchmark or fail to meet some downside benchmark, there could be some, upward or downward incentive accordingly. If we perform or don't perform, I hadn't understood that, our costs would become guaranteed to be recoverable, or we would be guaranteed to earn our authorized ROE on customer service related investments, or really anything beyond. There could be a financial incentive for hitting or not hitting that metric. You just help me with how it is that PIMs affect the utilities risk profile, what costs it is that we have our probability of recovering or not recovering change. And maybe this is get wrapped up into what you said about this is a long-term generational thing and it will become clear over time. But I think that piece was really difficult for me to follow.
So using your hypothetical, the very first thing, and this is pragmatism, not policy. Everywhere I've seen PIMs implemented by a regulatory authority, we kind of put our thumbs on the scale and try to make them pretty achievable. We don't really set it up so that the first thing you got to do is start imposing penalties. It's just not a good way to make friends, right? So what ends up happening is, as much as I've argued against them, a fair number of these PIMs are pretty easy to achieve. So I start with that as a pragmatic bias in my assessment. You're going to have room to succeed. We want you to succeed. Longer discussion, but phase one of the sulfur dioxide approach under the Clean Air Act. Nobody felt any pain on allowance costs in phase one. Phase two, it started getting a little more serious, but you had 5 years to learn how to do it. Okay? You're going to have a whole multi-year rate plan to learn how to do it, right? Number two is that the utility has a much wider range of tools with which to achieve those results. and you have a strong incentive to get creative about understanding and deploying those tools. A personal example, is the very first thing when I was at a utility, the very first thing we did when somebody called in with bill problems was we enrolled them in a green power product because that had stable pricing for 10 years, and we knew that it would help them on their bill management. Not in the normal, doesn't normally come up when thinking about how do I deal with reducing disconnects, but manageable bills are a great way to do that. So that's just one example of sort of you've got more innovation, you've got innovation waiting for you so that you can find ways to address that. And so between that and I'll just, because I'm taking too much time, but I tend to think that this upside opportunity that you have that you did not have before, right? Sort of traditional regulation is the beatings will continue until your morale improves, but you'll have an opportunity for some handouts and that you can earn. And to me, that's a risk reducer as compared to all the other, and by the way, this all will be set out in advance. You know what it is from day one, not when the day you finally file your rate case or when it becomes a big enough problem that you have to file a rate case. So
I have some more comments, but that was very helpful, and thank you.
Thank you. All right, Mr. White.
A question to save the sound, following up a bit on the topic that we had been discussing before about a 6% return versus a 9.6% return. Is it possible that with a symmetrical PIM, an investor's expected risk profile could change in a way such that the authorized ROE is reduced, yet an investor has such great confidence in the company that the investor expects the top PIM return will be achieved? For example, if a 9.5% ROE is established, then reduced by 100 basis points to 8.5% as the baseline, with a potential return of 10.5% based on exemplary service, might an investor view the company's management as, so exceptional that the investor would risk a lower return because the investor's view is that the 10.5% return is highly likely?
Yeah, I think the short answer is yes, and I sure as hell hope so, right? Because that's kind of what we're supposed to be at here. I think consumers and everyone benefits from a utility that earns 10.5% on a smaller level of capital spending as compared to earning 9.5%, just which they had to get by inflating the capital to unnecessary capital spend. Now, there's a lot of conditions in my example right there, but I would happily pay somebody 14%, at a utility to meaningfully address low-income affordability, right? Because I can find ways in which that actually creates great benefits for that function. Now, 14% enterprise-wide for that's when you start getting to my comment about sort of functional ROEs and the opportunities. And this is one of the comments that Eversource's witness, I think, made in attachment 2, which is that, so far, because we've been using enterprise-wide ROE, we've always been constrained to how big a bite we can take. Maybe there's only 100 basis points at play for the entire PBR plan. And it's so diversified that it's really hard to motivate investor confidence. So I think there's work to be done on finding ways to not just make sure that the utility and their investors can smell the cheese, but it's big enough to constitute a decent meal. Sorry, I had to do that in, New England Electric's home air.
Thank you.
I think in terms of, investors evaluating investment opportunities certainly would take company management into account, but I think first and foremost would evaluate the regulatory framework that we're talking about with PBR. So it gets back to exactly where I started, and I apologize for being a broken record. I think if investors evaluate the regulatory framework and identify that it is structurally set up in a way that the utility does not have that opportunity to earn its authorized ROE, it won't matter how effective the management of that utility is. The investors will see that it's a bad place for their investment and will choose to invest elsewhere. And structurally, the fact that the PBR framework, as it's designed as it is today, again, it's systematically taking costs out of rates such that even a perfectly run utility wouldn't be able to earn its authorized ROE in a given year. Because again, it's not allowing for post-test year changes to expenses in rates. It's not allowing for there to be incremental capital, even if there's a demonstration that there needs to be. It's not allowing for an X factor. It's setting depreciation at historical levels. It's systematically and systemically reducing rates below the cost of service just in that first rate year. Investors aren't going to look at that and say, well, Eversource is a well-run company. They can do this. In fact, that's what's happening now. We're one of the steepest discounted utilities of all investor-owned utilities in the United States of America because of the Connecticut regulatory environment. And they're looking at the regulatory environment as saying this is just too much risk, even for only 25% of the company. They're saying it is just not worth our time to invest in Eversource because of the uncertainty and the risk and all the things that were in the credit rating agency actions that have taken. Investors are looking at it and saying, stop, don't move forward with investment in Connecticut because it is just too risky. It's not an Eversource management thing, it is a regulatory environment thing.
Let me just follow up briefly. So yeah, I think part of this, and this may not be the answer that I necessarily want to give to that question, but I think one part of that answer is that an investor will not take that risk if the utility is saying that it is impossible to achieve the PIM, right? At a certain point, some of these are self-fulfilling prophecies when it comes to how the credit markets view regulatory risk. So that goes to both the importance of designing PIMs that are achievable, which is what we all want to improve the utility performance. But it also, I think, is going to be impacted at a practical level by sort of the how these PIMs are being discussed in the markets by the utilities themselves, which is probably just an unfortunate reality.
Maybe if I could jump on that, because I've heard that sentiment before, and it seems to imply that this is like a marketing or a branding issue by the utilities, as if we're out there trying to make the perception of the regulatory environment be worse than it actually is. And what I struggle to understand is how, at the same time, I can be out there telling investors this is a bad regulatory environment, and at the same time, I am also being told that I am only out for investors and shareholders and trying to prop up and pump up my share price. How is it possible that I am both killing the share price by telling investors this is worse than it is, and at the same time, I am a greedy corporate utility executive who was only interested in shareholders and propping up artificially my stock price? I don't understand how those two things reconcile. I think we are realistic with the challenges that we face because we have to be able, to the point about utility management, what investors want to know is, will utility management be able to deliver on the returns that they're projecting to the market? Will they execute on what they're conveying to the market? That is a major factor in a utility management scorecard. So we are realistic with our investors for sure. We would go to jail if we weren't, but I don't understand how those two things reconcile. So please help me.
Well, I'll tell you just based on experience, because I've had conversations with roomfuls of rating analysts loaded with ammunition provided by utilities about how regulation that I was overseeing was inadequate to support a reasonable level of return. And that is that sometimes it's easier to send rate analysts down the line than it is to do basically what I thought was the hard work of figuring out how to get the job done. That they exert, because they are functionally identical to your shareholders, they exert immense pressure on regulators using things like, who does that? The RRA's report card on you, now Standard & Poor's evaluation, reports like the Moody's study that are made to make you feel as a regulator like you're behind the pack. There's even academic studies, by the way, that make this point extremely clear. A great study I'll be glad to share that came out of University of South Carolina, somewhere in South Carolina, a couple of years ago, that said that you cannot explain what there was then a 700 basis point differential between allowed ROEs and the risk-free cost of capital on any economic or financial factor except for the herd effect of regulators and the stickiness of the 10% allowed ROE magical number that's out there. So there's lots of reasons why I can see a utility trying to use a rating agency to carry their water to try to engender exercise of the subjective authority that regulators hold.
So we
I
are
hear-
we
I
are
hear,
going
Mr.
to our
I hear
rating
both of
agency.
your
then-
points. I've
Just-
heard
I
you,
can't let that
and Mr. Rabago, I've heard you as well. I want to bring it just back to the question at hand on ROE calculation, relationship to PIMS, and what technical point about that you made, Mr. Rabago, and that Save the Sound has raised previously in this proceeding around functionalized ROE. And I am curious if, I know there have been comments submitted previously, but if you could elaborate in the conversation today about other jurisdictions that use functionalized ROEs so that we can help understand the extent to which that may factor in here.
Yeah, so first of all, the term is from the Hawaii PBR legislation. The sense of it, which I encountered before that, was when I was a utility guy running energy efficiency programs. And what I realized that in the CFO's office, the energy efficiency programs do not have a CFO constituency. They're seen as a program cost, even though they have a substantial role to play in decreasing the cost of service and addressing other critical performance goals that we have for utilities, like low-income affordability and things like that. So when I encountered it in the bill and sat down with the senator that wrote the bill in Hawaii over dinner one night, the idea was that a functionalized ROE would say, for the costs associated with this particular function, this activity, you could have an ROE that deviated from the enterprise-wide ROE. So that's the concept. So all the money you spend on, choose your outcome, energy efficiency programs or whatever, is authorized to earn this number that is appropriate to that task. It allows you to say that, pouring concrete is relatively low risk if it's on utility property, et cetera, but, improving affordability for low-income customers is harder to do. It deserves a bigger return if successfully achieved. I don't know of any place, I don't think Hawaii's gotten to using their statutory authority on this yet. I don't know of any place that's doing it under that name, but I think, my sense of my experience in the business is that there are probably dozens, if not more, places where utilities earn incentives for achieving particular results in particular, on particular functions. They haven't been pulled together into a PBR environment and then labeled as a functional ROE thing. But if you use kind of like the OCC approach, saying that from an accounting perspective, there's the kind of the gross up that we do with rate of return, when you've run through all the costs and then you apply the rate of return to that, this would be another line in the accounting that said earned incentives right below that, and which together constitute, a total added return on just the cost of service. So does that help?
I think it answers the question insofar as there's not a jurisdiction
Yeah,
here
no,
where
I don't
it is
know of one.
implementing it, which, okay,
Yep.
we can leave it there then.
That question.
We have another topic to get to and to dive into before the break ideally, which is to speak a little bit about revenue requirements. So I'm going to switch gears to those questions and I'll turn it to Mr. White.
Thank you. So this is for OCC. Save the Sound mentioned in their comments about Vermont PUC with the decision that related to a reduction in ROE, 100 basis points. So I believe it went from 9.5% down to 8.5% as the new baseline. There's also OCC mentioned in your written comments, regulatory assistance project white paper. Included in there was about a 0.25% reduction in relation to a settlement agreement in Rhode Island. And what I'm wondering about is OCC aware of any jurisdictions that have used PIMS as a reduction to the authorized revenue requirements?
I don't know off the top of my head, but we have been talking about that a lot internally because there isn't actually a difference, right? I mean, if you're reducing the authorized ROE by 100 basis points, there's a revenue impact to that, and there's a cash value to that ROE reduction that you are applying to the revenue requirement. So there isn't any reason in my mind why, like, structuring it as a overall percentage return on the equity component of rate base is just sort of like the way we think of it, but there isn't anything that necessarily necessitates the adjustment being to the rate of return as opposed to just the revenue requirement. I think that it's maybe like conceptually harder to get around because we all tend to think of like the revenue requirement being the pre-gross up, we determine the level of revenue necessary to support all the costs, and then we kind of apply a return to that. So adjusting the revenue requirement might feel kind of like you're intentionally authorizing some level of revenue that's less than what's necessary to cover costs. And I get that sensation, but like I said, it doesn't make sense if you think about it too hard, because anytime you reduce or increase ROE, you're reducing or increasing the revenue requirement. But we can definitely look into whether there are states that structure PIMs specific to revenue instead of returns.
If I could just say a couple comments in response, it strikes me that building in some adjustment to the authorized revenue requirement for a PIM, whether you do it in terms of basis points of ROE or dollars of revenue requirement, is tantamount to baking in a penalty to the revenue requirement, saying we're going to start off by letting you charge rates that are insufficient to cover your cost, and then rely on the utility being able to achieve whatever PIM it is that's being baked into the revenue requirement to earn up to your statutorily entitled opportunity to earn your authorized ROE. And, if we get PIMs that are of the ilk Mr. Robigo described, freebies, I think, I don't think you used that exact word, but that was kind of the gist of what I understood you've seen in other jurisdictions. Maybe, I don't know, we'd have to think about whether that was okay, but I think that is in effect what you're doing. You're baking in a penalty. I guess it's conceivably possible you could bake in a reward, although I would be surprised if OCC suggested that. And so I think I just want to make sure we're calling a spade a spade.
Mr. Hurwitz, though, if we're talking about it from maybe more of a point of hypothetically neutrality, right? We're not talking about starting with a haircut to ROE, but instead, grossing up to the revenue requirement and saying that, again, hypothetically, there's additional revenue that could be earned on top of this, and there's a penalty that could be applied to take it away based on performance. Does the company have a position on that type of scenario?
Well, I think if you're starting from a position of neutrality, there would be nothing to bake in to the revenue requirement, because you would be assuming there's no upward or downward to be earned. But I think, and maybe I misunderstood what OCC was proposing, and if that's the case, I'm definitely open to having my perspective changed. But as I understood the proposal, it was take a PIM or a collection of PIMs and change the base distribution revenue requirement to reflect some overage or underage, whether that's done in dollars or basis points. I think the comment is the same. And if that's what you're doing, I think you're baking in that penalty in the revenue requirement. And maybe you're providing some opportunity to get back. I don't know. I haven't understood how that would work fully from what I've read in REO2 just yet, but that is my understanding of what that suggestion is in effect.
Will, do you want to respond?
Sure. I was just going to say, I don't disagree. I think all I was saying just now is I think what Mr. Hurwitz agrees with, which is that whether you call it a basis point adjustment or a dollar figure is irrelevant ultimately, because it's either way has the equivalent impact on the authorized revenue requirement. I think then there's like the secondary question of whether it's appropriate to set a revenue requirement with an adjustment baked into it before like the outset of the rate year. I think that question probably comes down to whether what you're trying to do is incent expected versus exemplary performance. Like I think if you were to reduce a revenue requirement to as like a pre-penalty in a way that provides the company less money than necessary for expected performance, that does seem more problematic along the lines of what Mr. Hurwitz was saying than building a revenue requirement and offering the opportunity to increase the revenue requirement for exemplary performance, which kind of numerically could look the same either way. You know what I'm saying? Like at the end of the day, you could have a revenue requirement that says you can have up to 500 million, but for now you're only getting 475 million, just pulling those numbers out of nowhere. Either of those, whether you can kind of get to that point one way or the other, and it matters a lot, I think, how you get there, if that makes sense.
And just to add in, from a rating agency perspective, what they're going to be looking at is the cash flow metrics. So to what Attorney Wheel was saying, if it should have been 500 million and you're getting 475 million, to the extent that your cash flow metrics are going up, coming down, going up, coming down, that's not viewed favorably. So what they want to be able to do and what we want to be able to do is look and predict what that cash flow is going to be. So you don't want to have it so you're only earning 475 that first year, although everyone thinks you're going to get those PIMs, you meet the PIMs, you get 25, but the second year PIMs are not achievable, and so you don't get any of those and you're back down to the 475. So when we're assessing like what this looks like from a revenue requirement standpoint, we have to take into account like what it's actually going to do to those key critical credit metrics, which is the funds from operations that's coming in.
That's right. I guess then, Ms. Van Lilding, is it the case that is what you're saying that the credit rating agencies or the company itself would assume the worst case scenario in this?
No, they'll look at what's actually going to come in for cash. So to the extent, if we said the base, I'm making it up, that we think we're going to achieve 500, but there's 25 million of PIMs, but you're only going to collect and set rates of the 475, and then if you make them, then you get 25 in rate year 2. They're only going to look at the 475 because I only have cash coming in the door of 475. They don't look at, oh, I'm going to get 25 in the next year. So your credit metrics for that upcoming year will be based on the 475. Then the next year when I have the 475 plus I got 25, now that year will count the 500 in the credit metrics and they'll go up. But they don't like the mountain of the ups and downs. They want stability and we want stability. And so to predict what our future cash flows are going to be. And so doing things like assuming you're going to meet them or not giving you the revenue up front will hurt those credit metrics.
And if I could just add 2 points, and I think the same would be true for equity investors who, again, only get what is actually earned, and what is actually earned based on generally accepted accounting principles, which we have to follow and earn in recording our return. So there, I'm sure, would be implications as to whether or not and when we could record that $25 million as income. If you're setting rates, and I think for this example, I think we've come to assume that the cast-off rates or the cost of service is 500 million, and then it's a question of whether PURA would set the revenues initially to recover 475, and is that 25 million deduction ROE or a cost component was the question. I think a couple of things to consider is from an equity investor standpoint, the earned returns would likely be recorded at that 475. I don't know that we'd be able to accrue the 25 because it's income. You can't accrue based on a hope and a prayer. You have to be able to account for things consistent with GAAP requirements. So that would be number one. So it would be not only a credit rating impact, it would be an equity investor impact because the earned return will be less. But also, if the question is, will we have an actual cost of service of 500, but rates set at 475. We've talked multiple times in our comments about ASC 980, and Alan can speak to the point that that could be called into question, but if our rates don't reflect our costs, then we would potentially lose the ability to follow ASC 980 and regulatory accounting, which would put us on an island relative to our peers. And again, at some point, equity investors just don't waste their time trying to parse out the complexity of, a utility that is on its own, or Connecticut utilities that are on its own, unable to follow ASC 980. So I think it would really matter how you're determining that deduct and on what basis.
So again, just to follow up on that, related, similar to the question I asked Mr. Hurwitz, is that only a concern for following ASC 980 in the instance that it presumes a haircut on revenue from the beginning? Or if it's starting at a point of neutrality where the revenue requirement is what it is, and then based on performance, that amount that's able to be collected to be adjusted up or down, would that impact the company's ability to follow ASC 980?
I think is what you're saying. So if this example is that let's just say, for the sake of this example, that it's a $500 million revenue requirement inclusive of an ROE that is set to pick whatever number in our brains that you want to assume is right, meaning the base level of return on equity that the utility has to earn to attract capital as set by PURA. So it's not been lowered or increased to reflect, it's just the base level of ROE. So rates need to be set to collect $500 million in this example. There will come a point, and I don't know when that is, I wouldn't want to test it, that ASC 980 could be called into question. Certainly if the regulator is saying that the cost of service is 500, but we're going to set it at something less than that, for whether it's a lower ROE or a lower hit deduct to O&M, it's setting rates that are less than the cost, then I think we would start to have to explain to parties that be whether and to what extent we're still able to follow ASC 980. And again, Alan, much more able to speak to this than I, but at some point, if the regulator is knowingly, willfully setting rates that are different than our costs, that is the essence of when ASC 980 would be called into question.
Yeah, I was just going to say, I think Doug said it right. If 500 million is the amount that gets you to the established rate of return on equity, and you know that, and that's what everybody else is getting, and the commission says, well, we're going to set rates at some lower amount. At some point in time, you have to look at all the facts and circumstances. You'd say, well, you're not recovering your costs, including a return on equity, so you're no longer on ASC 980. Now, is that number 490, 475, 100? There's probably some places where you'd say, well, if you're supposed to earn 500 and you're only earning 100, that's not a fair return. That's not a reasonable return. That would get you off 980. But there's a range, some level, because right now everybody doesn't have the same return on equity. Some have 9.5, some have 9.7, 9.3, right? There's a pretty tight range. But if somebody all of a sudden said, well, we're going to set rates on purpose to start at 300, that would be a problem.
I guess, and I see you, Attorney Pace, if you could allow me just one more follow-up here. What I'm still not clear on is because what we're trying to do with this line of questioning is understand and sort of evaluate a proposal that the OCC put in their comments, or the idea, right, that this could be done using revenue requirements and doesn't have to necessarily be done with ROE in terms of the impact of PIMS. And so my question is, if their revenue requirement is set as it always is, or as it has been, I should say, and then PIMS are only applied, over or underperformance on PIMS is applied as an increase or decrease to the revenue requirement, does that affect the utility's ability to comply with ASC 980?
I still need to understand the hypothetical better. I'm sorry. So under the Attorney Wheels or the OCC's framework, the cost of service is 500 million, and that includes an ROE at, again, pick a percent in your brain, whatever it is. So that's the result that says that in the rate year, the utility's cost of service is $500 million. And then is the question, well, we would like to set revenues to collect 475,
No.
No. What is the hypothetical?
The revenues are set to collect that 500 million.
Okay.
However, they could be adjusted based on performance thereafter, right? So over performance, you could potentially collect more. Under performance, you could potentially collect less based on that 500 million revenue requirement.
Okay, so I think I can answer. So if the framework is that its rates are set to collect 500 million and then PIMs are layered on top of that, to say that if for exemplary performance, the utility could earn an incentive that would allow us to collect even after the fact 10 million more, or for subpar performance, we would pay a penalty even after the fact to say pay 10 million. So that the end for that period, we would have either collected 510 or 490. So I think the bottom line is, no, we would not be at risk of violating ASC 980, provided that the level of those PIMs is designed in a, I would say, a reasonable manner. And again, Alan, please correct me. Like, that is exactly the framework we're supporting staunchly from the beginning. That is the way that this can work, and to have us have our incentives aligned with the objectives of PURA and stakeholders in this room, that will have the cost of service set, that the perfectly run utility will collect 500 million in revenues in the first year of the, and then we will be held to performance standards up and down for metrics that are decided and defined, provided that that incentive or penalty is not too large so that it will tip it over. We'd still have that opportunity if we perform reasonably, that will collect that 500 million, which reflects our cost of service. That's not going to put at jeopardy of ASC 980. If the penalty is, all of the cost of service, or if the penalty is set that it would reduce us to only collecting the cost of debt, there's a point in time where it would tip over. And I don't know that we have a crystal clear line as to where that would be. It's not been challenged, to my understanding, that utilities have had to move off because of adopting performance-based rate making. But that certainly within that framework is something that we're supporting.
Thank you, Mr. Horton. Attorney Paysat, would you like to comment?
Thank you. I'll be very brief. And the reason why I wanted to comment was I wanted to make sure we talked about an important legal point that's responsive to your question. So the question that you asked the panel members was, is it possible in a PBR framework here in Connecticut to have the going-in rates below the actual cost of service? So in Mr. Horton's hypothetical, we were saying if they can demonstrate in a rate case it's $500 million for a cost of service, can we set the revenue requirement below that? There's a legal factor, in my view, that impacts that, and that is in 16-244AA, subsection B, it says that when the authority is sitting down and developing the framework for PBR, it says in subsection B2, those standards and metrics have to apply the principles and guidelines in General Statute 16-19E. We know that 1619E, subsection A4, says that utilities should be allowed to recover their cost of service, provided they can demonstrate that's their cost of service. So the statutory framework here in Connecticut, in our view, is that PBR doesn't throw out cost of service. It builds upon that cost of service framework in 1619EA4, so a revenue requirement that's below the cost of service and then going in rates doesn't comply with 1619EA4 and also doesn't comply with the PBR statute, which cross-references that statute. So we're happy to brief that. That's helpful to the authority. I wanted to make sure we talked about that legal issue that we have here in Connecticut. Thank you.
Thank you for raising that, Attorney Pace. And for that reason, I was trying to clarify that under the hypothetical of not putting a haircut on the revenue requirement, but instead working from the basis of the revenue requirement up or down. So thank you for the legal point. I appreciate that.
I appreciate that.
We're a little bit later than we thought we might take the break, but I think now is as good a time as any to do so. Oh, I'm sorry, but do you want to
Sure.
answer the question before we do that?
Yeah, really quick. I don't disagree with anything Attorney Pace said. I just wanted to clarify. I think just why we brought this up to begin with, we weren't under the impression, I agree with Mr. Horton, that we were not trying to give the impression that the revenue requirement that PURA would determine 500 million is what's necessary, so your revenue is 475, as Mr. Kramer already put forth. And the reason we brought this up to begin with generally was just the concept to introduce the idea that maybe it might not necessarily make sense to structure PIMs, to structure incentives, whichever direction they go, as a percentage of the overall value of equity and rate base, and rather instead it could make sense to structure them as in cash dollars, and maybe particularly because it's not clear to us how over the course of a multi-year rate plan, like let's say you have a 25 basis point adder potential for like built into your revenue requirement. How do you account for that if 3 years into the rate plan, that adder kicks in, but rate base has increased by $400 million? Then you're talking about a numerical figure that's much different than what was in the mind of the commission at the time that that incentive was created. So that's why we introduced the concept. It wasn't about trying to reduce create a distinction between the cost of service and the actual revenue requirement.
That was super helpful. And I know we're trying to break, but just, I think that just crystallized it for me. So I think Attorney Will, what you're saying is basically trying to come up with a way to design the PIMs so that basically the utilities couldn't game it. I think is what you, like, if it was designed based on a percentage of whatever it is, and then we can, I think that totally makes sense to have the target, and that would actually be exactly to our point around having for investors and credit rating agencies, having clarity around how this could impact the utilities financials over the course of the PBR term. It would go to exactly that. If it's a shifting or moving target, or we're able to influence the size of the impact or somebody else is, that would be detrimental. So I would agree with that sentiment wholeheartedly. It does, to have a framework that just sets the target and that target is known is certainly something that Eversource supports.
Thank you. With that, I'm going to suggest that we take essentially a 15-minute break and come back at 3:10. So is that okay with you? All right. We'll return at 3:10 and continue the discussion. Thank you.
Okay, thank you. Welcome back. We'll go back on the record, Mr. Kramer.
Thank you, Chair Gillette. Just to resume on the last discussion point, I sort of hustled us to the break. However, I did want to come back to the comment that you closed with, Mr. Horton, where you were stating your agreement with the point that Attorney Wheel made. Could you just clarify specifically what you were agreeing with in the comment that he made? Because I think we were touching on a number of aspects of ROE and PIMS. And so I want to make sure that that was, well, for myself, because we were moving to the break, I want to make sure I have that straight.
Sure. What I understood Attorney Wheel's premise to be is that the penalty or incentive, two things. One would be, I think, outside of the base cost of service set for going in rates or cast off rates, inclusive of an ROE that we'll debate on what that ROE should be. So if it's 500 million with the appropriate ROE to attract the base level of capital, it's 500 million. Then I believe, so that was one piece that I am in intense agreement on. And then the other was that when we're setting a PIM for an incentive or a penalty beyond that, that it would be appropriate to have essentially a fixed target of what that PIM would be over the course of the PBR term. So say $5 million or whatever that is, it's a fixed target or some, appropriately confined target, which is to say that in the alternative, what Attorney Wheel was expressing a concern around is if you had the PIM be set at, say, 25 basis points of your ROE, and then 4 years down the line, rate base will have grown such that that 25 basis point calculation at the start was expected to be, say, 5 million. But now 4 years later, rate base has grown, that the PIM, the penalty or the incentive, is not 5 million, but it's 20 million. It's something because we have not changed the performance or changed the, how well or how poorly we've done, but it's that rate base has grown. I thought what Attorney Wheel was just concerned about is that if we have a moving target, especially a target that the utility controls, that could introduce some perverse incentive that we could control the target, and goose up whatever it is, rate base or whatever it is, and then have the PIM be outsized at the end of the term. And I see Attorney Wheel nodding, so I think that was the concern. I was just simply agreeing that it makes all the sense in the world to me to have the PIM be, if not an exact fixed number, but a confined moving target. So it's not something that we could influence or somebody else can influence that's outside of our, whatever it might be. To me, it just makes a lot of sense to have the PIM be appropriately sized and then not move a lot over the course of the PBR term.
Thank you. And Attorney Wheel, that accurately captures the point that you made.
Yes.
Okay.
Yeah, the point I was making was that I was just trying to clarify where we were coming from on the underlying comments that kind of sparked that whole conversation, that the reason that we had brought up PIMs being adjustment to revenue requirements as opposed to ROE was specifically that, just the idea that they'd be kind of dollar figure or set points in time as opposed to a percentage of anything that can change over the course of the rate term.
Mr. Arago,
Just very briefly, the only concern I have, because ultimately the arithmetic is that they all are related, right? But the only concern I have is that if I was your boss, I'd say, I want you to carefully consider the risk profile of every PIM. So don't hide in just coming up to the ultimate revenue requirement. Is this PIM really hard to achieve? Is it really easy to achieve? And so I think the time you spend investing in good PIM design should not be overlooked. It doesn't mean you ignore it under the approach that OCC was talking about, but it kind of relieves the pressure if you focus on the ultimate revenue requirement result, as an alternative to figuring out what is ROE in a world of PIMs. I think once you have a portfolio of PIMs, they're going to present a portfolio of risks that ultimately is going to characterize the risk of the enterprise, or more and more of the enterprise. So anyway, that's my only word of caution.
Thank you, Mr. Arago. All right. Mr. White, some more questions?
Thank you. Question to Eversource. Referring to your written comments from PwC, in order to minimize regulatory lag, could a prudency review be conducted after the plan ends, with a lesser review being conducted on a more frequent basis, perhaps annually? In other words, to minimize rate shock, could a non-prudency review be conducted to update rates annually while allowing for a prudency review to be conducted after 4 years?
I mean, I think the way that I think about it is the PBR framework, it's not moving away from cost of service principles. It's just moving away from cost of service rate making, where, you know, all of the costs are reviewed in a rate case on a more frequent basis, which would include prudency reviews. So, and again, it's giving trust to the process and to utility managers to operate the business under the envelope of revenues that the PBR framework provides. So a long way of saying, I think that could work, provided that the rules for prudence are known and how they're going to be applied, so that there's not uncertainty into getting to the end of the PBR term and having there be some surprise in terms of how prudency will be evaluated or considered. But I mean, again, if we're moving to a PBR framework as compared to some alternative, more frequent rate cases or a capital cost recovery mechanism that generally will require a prudency review on an annual basis, I think you're going to have some substitute for a full prudency review along the way. Otherwise, you'll never get through the prudency review and have rates set to the level that they need to be over the course of the term.
Thank you.
And just to add to that, if I could, and I won't harp too much on, you know, the straw proposal and it being that the challenges of making proposals without having an update. But I think hearkening to the K-bar, I think whether we use a fixed or historical approach might be one thing that impacts the answer to your question. If we're using a strictly historical approach to K-bar, as I understand OCC has proposed, you know, all of the historical plant additions that would be used to compute a K-bar addition going forward would be reviewed for prudence in that very same rate case. And so therefore, you're calculating that envelope of funding throughout the rate plan based only on historical plant additions that have already been found to be used and useful. If conversely, you're contemplating something more along the lines of a rolling K-bar of the like that has been used in Massachusetts, maybe that leans PURA or other parties towards a more regular prudence review, where you want to roll in some additional years of plant additions into the calculations, to either roll the savings to customers to the event the utility is able to deliver the expected level of performance with a lower level of plant additions than is reflected in rates, or provide the utility some better cost recovery than it would get having to wait for the next rate case if it spends over the level reflected in rates. If you want to roll in those additions into rates on a more regular basis, you could see that, you know, making it make sense to do a more regular prudence review. So I just wanted to add that logical connection to the group's consideration.
Thank you. Question to Eversource on the PwC comments from November 6th. You noted from a financial standpoint, generally PIMs do not represent a material portion of a utility's revenue requirement, nor do they have a material impact on a utility's earnings, end quote. The company stated generally. Is the company aware of any jurisdictions that have included a PIM that represented a material portion of a utility's revenue requirement or had a material impact on a utility's earnings?
I think in one of the topics for today, which I was interested to see, is materiality, and maybe this is what it was driving at. So materiality in the sense of, I mean, maybe it's more art than science. I think the PIMs need to be set at a level that is quote unquote material, so that it's motivating the behavior that it's intended to. Our point though is, and has been, that again, from a structural perspective, the utility has to be able to have the opportunity to collect that $500 million growing over the course or adjusting over the course of the PBR term, meaning the 500 million is the inclusive of the level that a well-run utility is able to make investments and attract capital to continue to make those investments over time. So if the PIM is designed in a way that it tips that over at whatever point that is, if the PIMs are too easy to achieve, the gimmies that I don't think anyone is advocating for, or too hard to achieve, that it's just inherent penalty, and that penalty or incentive is too big in either way, then it's going to have outsized consequences. It will either do as Attorney Goodman said in the CIEC comments, it will either drive unintended behaviors by the utility in order to avoid the penalty, spending in areas where it may not be the most efficient to do that just to avoid a penalty, or to pursue an outsized incentive. I don't have a crystal, like I don't have a perfect amount as to what that incentive level should be. We have proposed concepts as to how to structure it that would be quote material, but wouldn't tip over one way or the other. But that's what we're trying to drive at, is it needs to be enough to motivate behavior, but not too much that in either direction it tips things over, either resulting in, too much penalty exposure that it becomes outsized risk, or too much incentive exposure that it becomes a burden on customers. That's the balance that I think we're all trying to get to with this framework.
Attorney Goodman, as a follow-up to that, and noting that, or as Mr. Hart noted, that this was an issue that CIEC had raised in its comments. Does CIEC or do your members have a perspective on what a material PIM incentive or penalty would look like? A range, an idea, a principle, something that you want to discuss today?
I think the short answer is no. I mean, we don't have anything specific. We can discuss what a material amount in relation to an overall revenue requirement is. I think in one of our comments, I don't remember which filing it was, we noted that New York PSC, at least for deferral accounting petitions, for example, has, I think it sets materiality range of, I believe it was above 3 or 5% of operating revenues. I think that's probably not really applicable to PIMs though. And I realize it's not constructive commentary to point out the obvious problems without a solution, but it is a difficult nut to crack. And I think it depends on, it's also hard in the abstract, I think, without looking at the specific dollar amounts, because if we agree that the utility should have a reasonable opportunity to recover its cost of service, its revenue requirement. And that cost of service presumably reflects enough money to achieve the expected performance. I think is the phrase or something similar to it that Attorney Wheel used earlier. So if the PIM is set to provide an incentive that goes above and beyond that for exceptional performance, again, what's material, I think it really depends on what that cost service is, I think, and what it might be. And because ultimately, we would be concerned about what the rate impact would be. And if, our concern is that an incentive that is material enough to really encourage exceptional performance, that amount of reward would have an adverse and material impact on customers. And something that is small enough to not have that material rate impact on customers might not encourage the exceptional performance the authority wants. So again, I know I'm not offering a constructive solution here and repeating what we said, but that's the dilemma that we see, is that it's hard to, we're not sure where that balance is. I think, one point we can look to for reference, just final comment, is in New York, still under cost service rate making, they don't have PBR. Excuse me. However, they do have what are called earnings adjustment mechanisms, which function kind of like PIMs. And they're for consistency across utilities for a particular PIM, it might be set at a basis point level for low, medium, high targets, but there's always a dollar value associated for the reasons we discussed. And I think once you're looking at those dollar values in the context of specific utilities, cost of service, and can quantify what the rate impact would be, it's a little easier to start making judgments as to how much is too much in terms of trying to provide an incentive for the utility and how much might not be enough, because you can really assess what the rate impact to customers would be. And also, as is a matter of, again, basis points or potential earnings, quantify what the benefit to the utility would be.
I'll echo that from my work for 5 years on New York in the REV process. My sense was that the EIMs originally instituted for energy efficiency were seen as being sufficiently material, at least to the executive that I talked to who was in charge of the energy efficiency programs, and has the added benefit that success is saving everybody money. So it's kind of a pay for type activity that you're encouraging, right? You can denominate it in reductions in costs and then offset it. As long as you don't over offset it, you come out with a net benefit. There's still some headroom there. And with efficiency, for example, in particular, that exists. The other thing I would add on this point is that I believe Rio started with just transmission and distribution. So you can change the denominator too. You can implement PBR with a smaller subsection of the utility operations. And by doing that, increase the opportunity for having a material effect in terms of, spending and performance, instead of trying the whole enterprise-wide type, basis points. Just focus on one section at a time as you implement it, which ultimately gets you to the point which I'm sure you were sure I was going to say, which is that if you functionalize your ROEs, you can get to materiality pretty fast.
Could I just add 2 more points quickly?
Yes, and then Ms. Van Lilling, I see you reaching for the mic too.
Thank you. Just to elaborate briefly, I think when the rate impact is being considered, it should be looked at holistically. So for example, again, an EAM in New York promoting DER utilization, which really means interconnecting more distributed solar, potentially storage. In that context, customers are paying for programs to subsidize or incentivize the development of the projects. They'd be paying the utilities costs to interconnect those projects, whatever the cost might be, and then also potentially paying the customer-funded shareholder incentive for the EAM. So there's a different layer of costs there, and if you just look at it in terms of what the potential cost to customers would be for the EAM itself or the PIM itself, you're not seeing the full rate impact to customers. And that's one. And the second point is, again, just looking to New York as an example, there have been a couple instances where the Public Service Commission has decided that based on changed market conditions and also successes of the utilities, that an EAM should be retired or no longer offered, because it's now, to the extent that it was intended to, in that jurisdiction, to promote exceptional performance and try to help jumpstart a market where the commission thought there was a need to help to make that happen. Once the circumstances actually changed, where it appeared that you could pull that incentive away from the utility, the market would continue to develop DER, continue to invest in energy efficiency, for example, under its own steam without the additional motivation of the utility and their, trying to earn an incentive, that could be retired. And that's just I think something that I believe, again, in an earlier filing had recommended that whatever PIMs are adopted in the PBR framework, that they be evaluated from time to time to make sure that there's still a true policy need for them to encourage that behavior, as opposed to deciding, based on changed circumstances. I think there could come a time when that PIM could just be retired and the money could be put towards encouraging some other policy outcome.
Ms. Van Lilling?
Thank you. And I agree with what Attorney Goodman was saying, but just in terms of materiality, it's going to be defined differently depending on who the stakeholder is. So some stakeholders might care about what the percentages of the revenue requirement. So let's use the $500 million revenue requirement and say there's 50 million of potential PIMs. So they might say, well, that's only 10%, so it's clearly not material. It's not a large component of the revenue requirement. If the stakeholder's concerned with net income, and those PIMs all have an impact to net income, and let's say the net income is $100 million for the 500 million revenue requirement, the 50 on the 100 is a 50% risk or 50% potential benefit. So depending on the view of what you individual stakeholder are your key index, revenue requirement, net income, ROE, would depend on the materiality level. And it may be material to one party and not material to another party because they're concerned with the revenue requirement, but this other person might be concerned with net income. So that's another tricky component when you're thinking about materiality as a whole that is not going to be defined the same by all parties sitting across the table.
And Ms. Van Lilling, you're identifying, I think, largely using maybe the term stakeholder and investor interchangeably?
No, not necessarily.
Okay.
Any stakeholder may define that differently. So a individual customer may look at, they care about what the revenue requirement is because they care what their bill is, or they may care what the utility is actually making, right? Because they want to understand how much the utility is taking home and how much of their money is going to that revenue requirement. So it depends on what that individual stakeholder is for their definition of materiality. To your question, investors probably are more concerned with the net income than a revenue requirement, but credit agencies will be looking at both a revenue requirement from a cash perspective, because that's the cash coming in the door, as well as net income. So it really is dependent on who that stakeholder is for what their key, like, individual primary index that they're looking at to measure for materiality.
Thank you. And thank you for the clarification. And the use of the term stakeholder was making me think about customers. What would the customer really see as material? And so for that, I have to come to OCC and ask Attorney Wheel, is there a perspective on materiality that Office of Consumer Counsel would like to enter in here?
I mean, I think what's material to customers is what's affordable. I mean, what it expands beyond the realm of affordability. And I thank you for the question, because it is, I mean, it's a reality that I hope we're all conscious of, that we can reach, and in my opinion have reached a point where for many customers, bills simply aren't affordable. And to a customer, they don't think about or care whether it's unaffordable because of a PIM or because of allowed ROE or because of a public benefit or any other portion of the bill. Like, none of that changes whether they can pay their bill or not. So I don't mean to diminish, I don't mean to suggest that customers don't understand rate making or don't care about how rates are made, but I hope you understand my point, which is just that materiality is becoming a smaller and smaller target for Connecticut ratepayers, meaning any increase, it feels increasingly material. I don't have a solution. If I had a solution to that problem, I probably wouldn't be sitting here, but I think that is something to keep in mind.
Question to Eversource. I'm referring to the LEI comments from November 6th. It noted the Hawaiian regulator further noted that the PIMs, while providing the utility with financial rewards for exemplary performance, were not a de-risking element for business operations. Regardless of whether a PIM de-risks business operations, do PIMs still allow the company the opportunity to earn its return?
I think it gets us back to everything we've been talking about today in terms of how they're structured, how the cast-off rates are set, how the companion PBR rate-making framework is designed. It all comes down to those very important details that, based on the framework from a year ago, PIMs couldn't resolve. The deficiencies in that STRA proposal were so significant, you wouldn't have that opportunity. So it wouldn't be a PIM discussion, it's the overall framework that's providing that risk or introducing that risk.
Thank you.
And this might not be directly responsive to either of the last two questions you've asked, but I think, and this might be a discussion more appropriately held for REO2, but it strikes me that the goal in setting a PIM is not necessarily to make it material per se, but rather to incentivize the behavior that you'd like to incentivize. And I think the level of financial penalty or reward, whether that's expressed in dollars or basis points, that causes a change in behavior might differ depending on the type of behavior in question. If there's a relatively low-cost, smaller part of the utilities operation, what qualifies as material or what qualifies as enough to change the utilities operations might differ from something that's core to their operations and foundational. So I just offer this to say, I don't know that the goal of setting a performance incentive mechanism is just de facto to have a material one, but rather to how to design a set of incentives that incentivize us as the utilities to deliver the performance that you want to see. And I think that might be, context is everything. Situations are situational. It depends on the exact thing being contemplated for a PIM.
Well, yeah, I hear that, but I would offer a slightly different view, which is that I think the goal of a PIM is to cost effectively incentivize an outcome. All those words. So it's got to be cost effective. So materiality does matter in the sense that does whatever if you're doing a benefit cost analysis, does whatever incentive you have to pay create costs that outweigh the potential benefit, right? So it has to cost effectively incentivize. And then ideally, the path to getting there moves to the discretion of the utility, right? And, would like that quote from Alberta, operating expenses, capital investments, whatever you think it takes to get there, here's the outcome we'd like to see. So it's general agreement, but sort of, I was a lawyer once too, so I have to be picky.
And I won't rehash a debate that I understand is taking place in REO2, but I understand a comment many parties have made in that proceeding is PIMs are supposed to be within the utility's control. And so I think they're incentivizing behavior and incentivizing outcomes. I would think there's a lot of overlap between those two things, I would imagine.
Just for the record, I'm going to say that I think probably we need clear definition of what control means, because my mind goes towards influence. The ability to influence as opposed to complete control, but that's my military background. I don't think it has to have an iron grip on every fact and circumstance that makes the outcome happen. It's influence more. But
Yeah, and we don't need to get into the control discussion here. And the straw proposal in REO2 did outline a description of the level of control that we proposed as appropriate. I think, Mr. White, did you have a question to follow up on that PIM and de-risking question?
What I just, no follow-up.
Okay. One of a way that I interpreted, or a possible way that I could interpret CIEC comments around, concern about materiality, concern about additional costs that PIMs could potentially add, and this idea of trying to find the right dollar amount or percentage amount for a PIM could be, and in a way that again, as I sort of read the CIEC comments, I was thinking, it sounded like that proposal, or between the lines, that proposal could be to say that upside opportunity is quite small and downside opportunity needs to be sized appropriately, and maybe not necessarily that it's big or small. But the concern that I heard from the comments on additional costs that would be passed through to customers was suggested to me that therefore upside incentives should be relatively modest. And I'm pairing that interpretation with something that I think I heard Mr. Rabago say, if not explicitly, maybe more implicitly, about gradualism, and taking an approach with PBR that I think learning as we go was something that you said. And so my question is, back to you, Attorney Goodman, if you put those two ideas together, what would CIEC, or was that intended to be a message that CIC was delivering in its comments, that in fact upside incentives should be modest, because we're contemplating PBR for the first time in Connecticut, that we wouldn't want to saddle customers with additional costs or significant additional costs tied to upside incentives?
Yes, but not just because it would be the first time we would iterate through PBR. I mean, our preference or opinion would be that Pure can simply direct the utilities to go pursue certain objectives, with recovery of costs, subject to recovery of the costs incurred, attempting to do that. For that reason, we don't think there's a need for the incentive, understanding though that that's a large point of trying to move of the PBR framework that's being developed. Yes, I think the point made earlier about materiality is in the eye of the beholder, or it depends on the perspective of who's looking at it. From the customer perspective, materiality probably would mean that the incentive should be modest, as you said, so that it doesn't have material impact to rates and therefore to bills. And I would say that I agree with what Attorney Wheel said a couple moments ago, that, paraphrase, I think that utility costs are increasingly high enough that even smaller increases to rates and bills now seem to be more and more material.
Understood. Just one moment.
Question for OCC. In referring to the November 6th written comments, OCC stated, quote, "A comprehensive PBR framework can be designed to substitute performance incentives for a portion of the allowed return. In this case, PIM rewards would constitute part of the utility's core compensation for expected levels of performance," end quote. So just to be clear on this, are you suggesting that if, for example, a standard ROE deliberation landed at 9.5%, then it could be set at 9.3% with the expectation that achieving a particular goal is imminently achievable and the 0.2% will be received by the EDC?
Not exactly at this, and this kind of gets to what I was saying earlier. And maybe I'm just getting hung up on the numbers. I think if the question is that under a normal ROE analysis, you'd arrive at 9.5%. If 9.5% is the commission's determination of the baseline minimum cost of equity, meaning like that 9.4% would mean no one would buy stock. So it has to be 9.5%. If that's the determination of the commission, then I don't think you can set ROE anywhere below 9.5%, because I think running into the conversation we just had, then you are actually setting cost below the cost of service, because you would have determined that 9.5% is the minimum cost necessary to attract equity. All that said, I personally I think that that cost is somewhere far below 9.5%. So if the question is, if the authority determines that 9.5% is ultimately what the allowed kind of ceiling should be, and that the utility's minimum cost of equity is somewhere south of that, then I think it can be appropriate to set an allowed ROE somewhere below 9.5%, and you'd be giving the utility the opportunity to earn up to something like 9.5%. But again, it's hard getting a little hung up on the numbers. I hope that comes across.
Thank you. So, another question for OCC. So we were previously having a discussion in terms of 6% versus 9.6%. So if you just take that into account, or just those are the numbers we're dealing with, from a ratepayer perspective, if an EDC's increased cost of capital was more than offset by that 3.6% reduction in ROE, could the 6% ROE benefit affordability and benefit ratepayers?
Can you repeat the question? I just want to make sure I understand.
Yeah, from a ratepayer perspective, if the increased cost of capital was more than offset by the 3.6% reduction in ROE,
I see.
could this situation benefit affordability and benefit ratepayers?
Sure. I mean, I think the question is sort of getting at the kind of a central kind of question that we have in this conversation as it unfolds in real life around rate case conversations, which is sort of the notion, we were talking about credit ratings earlier, the notion that the regulatory environment can increase the cost of capital, and an increase in the cost of capital must be avoided at all costs, as opposed to taking the view that acknowledging that investors care a lot about how much money utilities make. So if utilities make less money, investors don't like that. That does increase the cost of capital. But comparing that to the overall benefit, just like you would compare any two costs, the cost of capital should be, for rate-making purposes, treated like any other cost. So if the cost of capital increases, but it's offset by a vast decrease in somewhere else in the revenue requirement, then absolutely that benefits ratepayers, and that should be a consideration of this and every commission. It's not enough to just say, oh, we got a credit rating downgrade, or the stock market's not treating us so well. That means we need more money for the cost of capital, and you can't do that because that's bad for ratepayers. That doesn't make any sense. That's like saying, well, one cost went up because some other cost drastically went down. So since a cost in a vacuum increased, that's not customer supportive. Not suggesting that increased cost of capital is always a good thing by any means. I'm just saying that the conversation should be an objective view of what ultimately is the best outcome for ratepayers while maintaining, the legal standards that are required under the state and federal laws. So that was a very wordy answer to your question, but I think the answer is yes. I think that can benefit ratepayers.
Thank you. Thank you.
If I
Just to be clear, and maybe a question back to you or Attorney Wheel to clarify, if say that increased cost of capital was just because the volume of capital requirements was lower, and you get discounts if you float more equity, but we just need a much smaller amount, so it comes at a slightly higher rate, then essentially your comment is that might be an acceptable price to pay for the benefit you get by having a much reduced capital appetite.
Yeah, that would be an example, or a simpler example is if a utility got a $20 million rate decrease at the expense of maybe a $5 million increase in the cost of capital. I can see the concerns, and I'm not saying that's definitely a good thing, but I don't understand the argument that that's bad for customers. That's what I'm saying.
And if I could complete that argument, I think what you might be missing, Attorney Wheel, is the conversation doesn't just stop with that mathematical comparison. I think if you set rates that are below the utilities cost of service, we have no choice but to react to that, and that potentially will impair our ability to attract capital going forward. And we don't want to attract capital just because it's fun. We attract capital to invest in the system and invest in things that are in the best interest of customers. So if setting that below our actual cost of capital results in not only an increase in the cost of debt, which I agree, you could just do the math and figure out if, who won or who lost, but if it comes at the cost of the utility's ability to deliver the performance being expected in PBR, I would think your analysis would be incomplete, failing to consider that. And I understand, PBR stands for performance performance-based regulation. So I understand the whole intention of this is to deliver a certain level of performance to customers. And I would think any analysis of the appropriate cost of capital that fails to consider that would be woefully incomplete.
I wouldn't disagree. That's what I meant before by saying it's not the only thing to consider. I was just specifically referring to the notion that an increase to the cost of capital can't be good or can't be good for customers. But I certainly agree that there can be a point at which you erode the system where you ultimately end up with a product that's not, ultimately what we are concerned about is ratepayers getting the value that they're paying for. So you certainly can have a rate structure that's so restrictive that ratepayers cannot get what they're paying for. And that, I agree, is not an outcome we want.
And if I could just chime in with a couple of points that have been made, I think, and I do agree, especially in New England, we do have some of, if not the highest electricity prices in the country. That's well documented. But we also need to keep in mind in terms of from a customer perspective, and Attorney Wheel, please, if you have a different perspective, certainly more your bailiwick, but we do care about our customers, and our customers pay the total bill. So I always try to understand, as we're talking about PBR, we're talking about the distribution portion of the bill, which is currently about 20% of a customer's bill. And for Eversource, when we've looked at it, the distribution earnings are about $10 for a typical customer bill, about 5% of the total bill. And whether that is in the bill or not, when you look at the CLMP or Connecticut's electric rates, again, generally some of the highest in the country. And if you were to eliminate entirely the equity return that's built into the distribution portion of the bill, Connecticut ratepayers would still be paying the top 5 highest electricity prices in the country. It's just not a significant enough driver for us to move the needle. But yet, as we're talking about these impacts and having performance metrics, however they're defined, to the point Ms. Van Luling mentioned, materiality is very important. It's not material to a customer to eliminate, I guess this is the point I'm driving at. If we were to eliminate the entirety of equity return from the distribution portion of the bill, hey, I'll take it as a customer. I'll save $10 a month. I'll take anything. But you're still going to be paying the highest prices in the country. And our customers care about 2 things. They care about the rates they pay. They also care about the quality of service. And the frustration that I feel in these conversations, which I have with many people in Connecticut leadership, it's how we're talking about and approaching utility rate making and cutting costs of service or cutting rates below the cost of service with it seems to be the singular objective of minimizing or mitigating or undercutting shareholder return. I think we're setting false expectations for a customer in terms of the materiality of the benefit that's going to produce for them. It would not, even if you, again, eliminated entirely all of the net income that a distribution company is earning, they're only going to be saving a couple of cups of coffee a month, but yet it's going to make it infinitely harder for us to attract capital. And I could understand what Attorney Wheel is saying, that there's a calculus that should go into it is, do we really care if credit ratings are downgraded? Certainly I'm biased. I have an opinion that perhaps differs from others in this room. It not only affects the cost of capital for that issuance, it affects the cost of capital for that issuance for decades. It affects the cost of all of our operations. It also can come to a point where it affects our liquidity and our ability to ride out hard financial times of being able to access capital markets. And I would think you'd want your utility to be financially sound. I understand the impetus to try to control costs and achieve affordability, but it's misguided and misplaced to think that we're going to materially change the energy marketplace in New England by attacking shareholders and attacking equity return. And we're seeing that play out in the credit rating agency actions that have been taking and in the stock price, at least for Eversource, which we are at the very rock bottom. And that means that our cost of actual capital, that we do compete with other entities, other utilities and for-profit entities, we have to compete for that capital. Equity investors do not want to invest in Eversource, which means that the cost of capital for us to access capital is greater than our ability to earn, and publicly traded utilities or any company will not issue equity if it will have a diluting impact for equity investors. That's just not how the framework works. So I actually think, and I've had this conversation with others again who will listen, is if the goal is to try to minimize or mitigate or do away with shareholder return, I really think the discussion should shift into focus on, do we want to continue with the investor-owned utility model, or should we be looking at a state-run utility model that doesn't have equity investors? That is a conversation that I think should be seriously had, because if the objective is to simply try to, again, produce affordability benefits for customers by mitigating or eliminating or reducing the required return for investors. In this room, we don't have the ability to control that. Pura doesn't have the ability to change the way that capital markets in the United States of America operate. It just doesn't. So really, it does amount to an experiment that's being run on the utilities who are competing for capital intensely with other entities, and investors do not want to and don't have to provide us their capital. If our cost of capital, and they reflect that in the share price of our utilities, if our cost of capital exceeds the ability to earn, it is not possible for us to issue equity in order to make the investments in the state of Connecticut that will come at a cost that's greater than our ability to earn on those. And equity investors just will not give us their capital.
I could briefly add perspective of large customers. I think with just the principle that there is that balancing between what is the cost to customers for maintaining a particular credit rating, yes, there may be instances where it is not overall beneficial to pay more to increase the rate or improve the rating. However, I think customers do have an interest in ensuring that the utilities are financially healthy, which does tie into both credit rating and the authorized returns, not taking position on any particular rating or level of return, but it's important for them to maintain that the rates are sufficient to provide a return and credit rating sufficient for the reasons that, Eversource and UI have laid out. From the customer's perspective, the concern is that if the utility is not financially healthy, it ultimately can lead to increased costs for customers down the line, as well as degraded system reliability and resilience. And trying to eventually improve or, kind of restore the lost reliability and resilience, that's where some of the increased costs can come in, because it can take, many years and increased costs in order to try to restore that. So I can't tell you, even broadly where the ROE reduction or credit rating reduction potentially would tip you into that territory. But I think it's something that could be, would be evaluated on a case-by-case basis and should hopefully be at least that gray area clear enough, as we're making these determinations that, stakeholders and regulators steer clear to try to ensure that it doesn't push the utility into some sort of financial crisis or other outcome that ultimately could have an impact to customers as well.
Thank you, Attorney Goodman. All right. With that brings us to the conclusion of the questions that we had prepared for our discussion today. And so I'll say that please do stay tuned to the docket for further updates there. Our next technical meeting is tentatively scheduled for January 6th, 2025. And with that, Chairman, that's all that we had for today's session.
Thank you. In that case, I want to thank everybody for their participation this afternoon, and we are adjourned.